Hello, everybody. Welcome to day 3 of the Traders Summit. Hope everyone's
Morning.
doing okay. Good morning. How are you, Stel?
I'm very well, Coach.
Good
Steve, how
morning.
are you?
Good.
All right, so you guys know me, and maybe some attendees that know me know how much I like the number 3, right? Right? 3 drives.
Yeah.
The third time's a charm. If you're a hockey player, you want to get a hat trick. If you're a baseball player, 3 strikes, you're out. So the third time is a charm. Even in the realm of spirituality, the Godhead, it's 3 persons. So here's our third day on the Traders Summit. And what a lineup. Okay,
Indeed.
so we're going to kick it off with Chris Weston, then Ashraf Laidi. You guys, I've interviewed Ashraf. I look forward to talking to him. Then a few of our sponsors are going to be talking, Tyler Woods. I really enjoy talking to people I haven't met before. So Axel Kabar is going to be here.
Did you say Tiger Woods or Tyler Woods?
Tiger Woods is trying to make a comeback, so it's going to be Tyler Woods, and we're hoping that he doesn't 3-putt on his presentation. So anyway, and then we have Daniel Sinig from Trading Indicators, and Stephen Goldstein. And when I was doing a little bit of preparation for Jack Schwager, which is what we're going to wrap this day up with, which I'm very much
I think a great way to wrap up the day, right?
Yeah, I tell you what, you are going to be blown away by the title and what he wrote. And, we get to unveil the title.
Wow.
And, so it's really going to be...
That's amazing.
Everyone will want to read this book. Everyone that loved trading wizards is going to love this book. In fact...
And to be honest, they should start, if they haven't done so, with reading the previous ones first.
Oh, yeah, definitely.
I didn't want to interrupt Blake yesterday when he was talking about it because we were a little bit limited in time.
Yeah.
But I can tell you one thing for sure. One of the reasons that Jack Schwager's books will live forever is because, in essence, they're talking about the human traits that successful traders have. And since trading is 95% about psychology, human psychology has never changed. And that's why we see the same type of cycles in the market. So,
exactly.
So I think these books will be relevant even in 500 years from today.
And guys, do you know how like an actor will have a role, or a musician would have one great song and then they do other material that really can't, people are still enamored with their first piece of work, like we're talking about his, really his first major work, and you almost get typecast, and everything else you do after that doesn't really live up to your great work. Well, I think Jack has done it again. Okay, so it's really going to be, I was surprised when I saw the title. I actually, a little chill went down my spine because it's a hopeful piece for every trader out there.
Let me answer a question which people ask, continuously throughout the event so far. If they will be able to view previous interviews, presentations, etc. The answer is yes, you will. Our target is to have everything uploaded by Tuesday, and everybody that registered will receive an email, with a URL, so on and so forth. We just want to make sure we edit them, upload them. We have the best quality we can have, because don't forget that unfortunately, due to COVID, platforms like Zoom have dropped a little bit their quality, but still it's going to be decent, so you can go back and view. I think actually, I don't know if you agree, guys, but I think it's worth watching anything they might have missed. I can think of one interview or one conversation we had that isn't worth watching, or even watching again.
Yeah, and I'm hoping people that have been here all 3 days already have had some type of epiphany from what they've heard, and something that they, was not on their radar previously before this event, that's going to really make a difference in their life and their trading career. So that's the goal of the summit. The goal of the summit is to edify people that attend it, and also that watch the video afterwards. So I can say that for me, there's been a few interviews that I've heard things that have actually, started to change my views. And there's a few examples. I mean, how about Tracy being bullish crude, bullish the dollar at the same time, and Danielle's interview about, there really is a plunge protection team. We all thought that, was that real, or is that just, what bears talk about when their shorts aren't working anymore? So, it's, and the panel discussion was out.
Yeah, the debate,
there's just, I can't
debate
even
was
list
amazing.
it, or I would, if I kept going, I would probably bleed into Chris's time. So, I'm wondering out there, while we have a little time and you guys are there, if you could maybe put down in Traders Chat, what idea or speaker they first of all enjoyed, and what they actually would say is going to be, a big change for what they, way they viewed markets and their own trading before this weekend. Anyone out there have that type of moment, or learning something they learned that they didn't know? So, you could go ahead and put it in chat. I know it's early. Okay, David Hall said he liked the intermarket correlation between
Nick
gold and
says
lumber.
he wants to
Yeah.
rewatch all of them.
Yeah, Michael Guyette. Oh,
I
Michael
have to
Guyette.
say, I was blown away by Michael Guyette. He's really, really good, and his arguments and the whole thing, I just looked fantastic to me.
Okay, and Alex learned that equities can be an inflation hedge, and I always had a hard time with that concept too. That when we had inflation, you think you go to metals, and
just to be just to clarify something. Okay, Peter Schiff mentioned, even Peter Schiff accepted that stocks are a hedge for inflation. Huge distinction here is we're talking about stocks that have real book value. So stocks of companies that have real assets, right? We're not talking about stocks of companies that are valued like 200 times, 300 times sales,
right,
and some firecrackers like that, because these stocks will end up being a hedge against nothing, right? I mean, the only thing they hedge is, common sense and logic, nothing else.
You mean like snowflakes, Steve? When I told Mark Yusko that,
yeah, and Mark said,
I'm from Chicago, and
yeah,
I know snowflakes. I've seen them freeze, and I've seen them melt.
Yeah,
So,
and Mark was very adamant about that. He said, "Listen, there are companies that I do like. I do like their business model. I do like them as companies, but that doesn't change the fact that their valuation is just obscene, that there is no chance that you can buy them at this price, and unless you want to flip them immediately to a bigger fool, if you want to buy them and hold them, there's no chance that you're not going to lose tons of money. And that's the reality. I mean, people that have been in the markets or have studied recent history of markets know that the same type of mentality that we see surrounding several of these stocks was the same type of mentality we had with tech stocks
2000, yeah.
20 years ago, 21 years ago. And we all know how that ended. Ended with the NASDAQ losing 80% of its value, and several of these high-flying stocks completely disappearing. Many of these companies do not exist anymore.
Oh, you mean I shouldn't hope for WorldCom to start trading on the pink sheets again? This is a real shocker.
I still have pets.com. I don't know about you.
Well, that one, at least you could stroke it a little bit. But here's a real shocker. Joe Perry, like the discussion between Joe Perry and Brett
Oh my,
Steenbarger.
no way.
Yeah, he
I don't
did. He
believe
liked
this.
that a
Come
lot.
on,
You know
Joe.
what? I'll tell you what, Joe. I liked it too. I thought that Brett was really outstanding, and he even talked about how important it is that our P&Ls are just numbers, and the best way to overcome a bad P&L is to have other things, more important things than money, happening in your life. To have family and friends, and your relationships are important, because if you go home and that all you do is go to sleep with your P&L, which will get wrinkled and crinkled when you roll over it while you're sleeping, it's a pretty empty life. Even if you're generating your P&L is great. And we all go through drawdowns, so support of your coworkers. And how about this, being part of a community like on Forex Analytics, where people care and are rooting for you every day. And we don't allow the type of mentality of people that come in, and there are people like that root for you to fail and take pleasure in other people losing money, because they really need a shrink. Because they do that, they're only trying to rationalize their own inadequacy. So find a supportive community. And a theme throughout this is find a good mentor. Almost all of these guys had
To begin
mentors.
with, we do have an offer in Forex Analytics, but I'm not going to go over that. The simplest thing people can do to find the first community, I just put the link here, is a small version of what's happening here in the event we're doing on a daily basis on the face webinar, which is completely free, and it's daily, and it lasts 1.5 hours, half of it being interviews that Dale conducts. And yeah, we've talked on face several times about the processes that amateur traders go through. Initially, you believe that this is an easy way to make money. Then you start studying like indicators and things like that, believing that there is a magic bullet to kill the monster of the markets, meaning perhaps an indicator that gives you winning signals only, or some type of a methodology, or some type of an easy algorithm that you can apply and just look at your P&L, steadily move to the upside. Everybody that's been on the markets knows that that's not the case. That has never been the case. So it's a whole system that you need to develop, which starts by working on yourself. And as we said before, with the occasion of talking about Swagger's book, it's all about psychology to begin with. It's all about having the right mentality and the proper psychology to fight the good and the bad days in the markets, and be persistent and be there for the good and the bad days. Dale can tell you better than anybody. He's been in the markets since
200 years.
Since the Great Depression of the 20s. Yes.
I had the same discussion with W.D. Gann, and he was over at my house, and the tape
And
under
Dow,
the
not
glass.
Mark Dow. Not Mark Dow.
Charles Dow.
Charles
Okay?
Dow, yes.
His grandfather.
Yeah.
So anyway, yeah. So yeah, I've been in this forever. And, I hope everyone's enjoying this. And I think we're just a couple minutes away from bringing on Chris.
I see
Chris is here, yeah.
Chris is already on. So actually, why keep the guy waiting? I mean, Chris, if you're ready.
Welcome, Chris.
Thanks very much for having me. It's a pleasure.
Yeah, I've seen you on Twitter and, some of your work. And I've been looking forward to having a chance to talk to you. For people that don't know Chris, he's head of research for Pepperstone, been in the markets for a couple of decades, and you've worked at Credit Suisse, Morgan Stanley, and your exposure to FX, equities, fixed income put you in a unique position for looking at intermarket things. You have kind of a holistic approach to the market. You look at the whole jigsaw puzzle. And you've been on, all the major financial networks like Bloomberg, CNBC, and probably over there Sky News, right? That's probably on that side of the world. So, so Chris, welcome. I don't know if
Dale,
Steve.
it's a good opportunity to also remind people that haven't heard it in the
Pepperstone?
previous days that yes,
Yeah.
Forex Analytics and Pepperstone
Yeah. Go ahead.
collaborate with each other.
Tight.
Yes, very tight. So actually, people can take advantage of this. If you go to Forex Analytics, there is a link. You can see it. I'm sharing my screen. You can see it on the top right. It's called Forex Analytics Sponsored. And if you actually open a Pepperstone account, which you can do from, remind me if I'm mistaken about this, Chris, from any country on the planet, with the exception of US and Canada. Am I right about that?
Not every country.
Almost every
but
country on the planet, with the exception of the
there's a lot of countries, to be honest. We're regulated in quite a few these days.
If I move to Tasmania, Chris, can I open an account?
Well, it's part of Australia, so absolutely, 100%.
Oh, see, I didn't even know where it was.
You should definitely have a look at it. It gets cold at this time of year, though.
So if you actually open a Pepperstone account through this link on our site, specifically this one, because this is the only way we can track it, and you fund your account, you actually get 2 months of Forex Analytics for free, and you get another 2 months if you do 5 lots, which is really insignificant within 2 months to trade. I mean, I assume everybody's going to do that. So I strongly suggest taking advantage of that offer. Pepperstone is an amazing brokerage firm. There's no question about it. I think enough said about that. Chris, I'm going to let you take it over and see what you have to tell us today.
So Chris, is this just going to be an interview format, or do you have any presentation?
I've got a slide deck actually, which I'm trying to share the screen now.
You should be able, now that I stopped sharing mine, you should be able to do it. Green.
Okay.
There you go. It's coming up. There you go.
Okay. So what I've done is I've put a huge deck together, which is part of the framework, which I'm sort of hosting to clients anyway, because I mean you're all the speakers that you've had, I mean there would have been quite a few who would have been talking about the current Fed policy, the move to flexible average inflation targeting, the idea that real rates are driving the show these days. If you get your dollar call right, you're doing pretty much, you're going some way, but it's all sort of one big correlated trade. So sort of took a bit of time to put a deck together for trading this, and this is part of my framework because whilst I trade markets, I have a top-down framework by trying to understand what's making things move, what's making things tick. And I think from once you understand how things are interacting with each other, that can be really powerful for just understanding for your risk management. You can go into a lot of the option structures and use that volatility for position sizing and various factors. But I want to just go over the sort of top-down framework today, just a little bit about.
Right. Chris, have you ever seen the markets being so binary and tied together where like almost there's hardly any differentiation, maybe different degrees of magnitude, but pretty much everything's going up together and everything's going down together? Have you ever seen a period in the market like this?
I mean, this is an I mean, there's always times where correlations go to one. They usually obviously correlate with when you get implied volatility moving up exceptionally sharply, and we've still got quite elevated levels of implied volatility in equities.
Right.
But I think there's two things which are driving the show at the moment, and that is real rates and the dollar. And I think once you've got those two things in place, you're getting what's happening with the Nasdaq. You're getting your gold trade right, your growth stocks, all of that. So all of those that's all really one trade. And then you've got to look at the different players who are involved. Your systematic guys, your CTAs, your momentum. It's a momentum trade. The question is when does that end? And that's kind of what I really want to focus on. So we'll focus on that one trade there. I just want to come out and just give the disclaimer here that what I say today is going to be general advice. So yeah, I mean, I'm happy to go through the slides because I want to start off, Dale, and feel free. I didn't really know what to do. I mean, I was just going to sort of just talk, and if you want to ask questions along the way, I'm very happy to do so.
This is great. I know I'm going to learn some things, so I don't worry. You don't have to ask me to interrupt. It's kind of a habit of mine. So,
no, but please, if you
I'll
feel
try
like if you feel like this is going a bit hardcore, then and you want me to explain it in a bit more depth, then
thanks
please
for
do.
giving me power of attorney, buddy.
Yeah. So the first one, is, I just want to set the scene, right? Because I think a lot of people have talked about this. The Fed are now going to proactively target PCE inflation of 2%. They want to allow that to moderately exceed that for 2% for some time, which is the yellow line that you should be able to see here. That white line being the 2% target, and this is inflation here. You can see just the 6-month average in the green. So that's a difficult task, and I think part of the reason why we've seen markets under a bit of pressure recently is because the message from people like James Bullard, Charlie Evans, Powell coming out and trying to clear things up, is that the Fed really are very misaligned with their messaging at the moment. And I think when we get to December, there's going to be some significant changes. Once we get past the election, once we get into December, I think there's going to be some significant changes. The other point is that they want the economy to reach maximum employment. So there's 3 different factors, and effectively what they want is nirvana. They want, they want their cake and eat it, because these kind of conditions to get full employment, which if you look at their economic projections was 4.1%, they want all of these 3 things to happen at one time. It's very, very difficult for them to do. In fact, some would say that's kind of an impossible task given the history. If we go into this chart here, I'm looking at the euro-dollar futures. So this is a tradable interest rate market. I used to trade this back at one of the US banks. You can trade Fed funds and obviously swaps and various factors, but you can see here, this is the current euro-dollar contract. And what we're doing is we're looking at the yield and going up, really trying to add 25 basis points to this just to find out really, and this is what we do, is to try and understand when the first rate hike is being priced based on the anticipation of the Fed delivering those 3 tasks that we had a look at. And you can see here that this sort of cross-section here comes through in June 2024. So the market's saying at the moment, based on, it's kind of finger in the air stuff, really. They're just saying we're taking a guess that the first rate hike is going to be somewhere around June 24. Now, I think those rate expectations will get moved dramatically forward if we get fiscal stimulus. It's all about fiscal stimulus now. Maybe that comes after the election. Maybe that comes, in 2021, 22. Who knows? But it's all about fiscal now, and monetary policy really complementing fiscal going forward. But just to set the scene, we have this idea that the market is sort of anticipating the first rate hike in June 2024. What's important, Dale, if we go back to this chart here, and not a lot of people pick this out, and I think this is really, really, really key. If you have a look at the statement that they said in July, they said they were going to be buying assets at least at the current pace to sustain smooth market functioning and thereby fostering the effective transmission of monetary policy to broader financial conditions. So they're just trying to make sure that the monetary system works well. But the change, which not so many people picked up, was that they've added this little extra bit here, which is to continue making a smooth market functioning, but to foster accommodative financial conditions. What does that mean? What does it mean? It means that the Fed put is very much in play. It means that if there's any tightening in financial conditions, then they will buy US Treasuries and they will buy mortgage-backed securities. They have told us in this statement and the new changes, if we do see a tightening of financial conditions, that we're going to get more asset purchases, which takes me to this chart, because this is, for me, a really, really key situation. There's all these different indices that you can get. You can go to the St. Louis Fed website. You can have Bloomberg. I think you might even be able to get it on TradingView. I'm not sure, but they package, these different companies package these financial conditions indices into one. And you might incorporate things like the S&P. You might incorporate the VIX. You might incorporate money market rates. The TED spread, you might incorporate credit spreads, and all of this to understand what financial conditions indicate. Now, the Fed know that the tightening of financial conditions indicates that will come back, and there will be a feedback loop into the real economy. Tighter financial conditions. Did you say
TED spread, Chris?
Yeah, that would be one that some people use. Yeah, absolutely.
Yeah, okay. I mean, I used to trade it a lot. It's not in most people's vocabulary. So that's T-bills against euro dollars, not euro currency, euro dollars. The spread.
And that was something that.
Yeah, like a flight to quality type of spread. Yeah. Okay.
You know, it's a perception of counterparty risk.
Right.
And, you know, we were looking at that in 2008. It was one of the big things. But
Yeah,
you can see
right.
here that I like to look at the Goldman Sachs financial condition indices. And basically, when this is going lower, it means that financial conditions are easy and accommodative. And you can see here that they've started to tighten up a little bit. But this is where I start to say to myself, where is the strike price for this so-called Fed put? And what does it mean when we go there? So if we understand that the Fed now are saying that if financial conditions tighten, they will do more to more quantitative easing and more asset purchases, then I've got myself this situation where Goldman Sachs, if this starts to move higher, representing tighter financial conditions, the probability of QE will increase. And there's an indicator that I like to look at, which is a proprietary one from Citigroup, which is the probability of QE. At the moment, that stands around 83%, and that's had this just from this little tick up that we've seen in the tightening of financial conditions. So my belief is we get up to somewhere around here, and you know, if you don't have a Bloomberg terminal, go to the St. Louis Fed website. They've got their own one there that they look at, which is correlated to this. So I think if we get up to there, then I think the chance then that the Fed come out and start doing more US Treasuries and mortgage-backed purchases is very much assured. So, you know, this for me is really important. If there's a tighter financial conditions, the Fed have now told us that they will start doing QE. The question is what does that actually mean for markets? Now, how do they go about this, Dale? How do they go about creating what is the impossible task? They failed miserably for so long. It's not just about asset purchases. And for me, the way they go about doing this is real yields. I don't know if you've ever heard of the US dollar smile.
I have not.
Well, it's a theory that I mean, I could spend hours talking about this, to be fair, but basically if you look at this sort of this line here, this is kind of how the dollar genuinely used to trade. So if we had a situation where the rest of the world's growth was catching and converging with the US, or the US growth was falling at a rapid rate and the rest of the world was looking good, we tended to see the US dollar doing quite well. And what we saw for periods when the US dollar was strengthening was the US dollar exceptionalism story. And that's when the US dollar starts to strengthen. So this bit's a positive side. This is the right tail is a positive side. On the left side, this is when the dollar strengthens on safe haven flows. And so you've got, when did the dollar depreciate? It's when, you know, the rest of the world is catching up. And I think that's kind of what we saw for a large period of this year. The rest of the world was looking okay. The US was no longer this kind of the best house in a bad neighborhood. It was, you know, the rest of the world was a catching up. You know, COVID was looking a little better in Italy and all those other factors. And the dollar started weakening. And we obviously saw the trade-weighted dollar under pressure. And I think it's because we saw this part of the smile sort of working. And so, yeah, I mean, for people out there who've never heard of this, do go and Google the smile framework. It's got a really good sort of anticipation of how the dollar trades. You know, generally, if you start seeing the higher risk-off environment, the higher volatility environment, you tend to see the US dollar appreciate on negative factors. And then on the other side, if the US dollar is looking better, if the US is looking better relative to the rest of the world, you tend to see that situation. What the Fed have effectively done.
Can I just interject something? So the rest of the world has been catching up with the US, but when you look at bourses and equities, the S&P 500 made new all-time highs, and then you look at something like the FTSE, which only corrected, and a lot of the major world bourses have not made new highs. I know they, you know, the composition's different. They don't have, you know, the fangs. So is that saying, and I'm not, and on this recovery, does it look like the U.S. is still leading the way and the stock market's giving us a correct message, or is it just kind of an aberration with what's happening with growth, some of the growth stocks here?
Yeah, I mean, I think what's happened with equities is a completely different story. I think that's a momentum trade, and I think in the US it's been down to stimulus.
Yeah.
But I think the idea here is, let me just go into this point because you'll see this quite clearly in the next couple of slides. This will all make a little bit more sense. This idea that the dollar would significantly strengthen in a risk-off environment of old, or significantly strengthen in a period of where the US is looking so much better. What the Fed have effectively done by allowing the economies to run hot now is they've separated that link. So the dollar now, if we get that, is going to strengthen, but not by much, not by the same sort of magnitude that it would have done before, because the Fed have separated that link. But what the Fed are now trying to do is this whole model that many people would be fairly familiar with. Is they've changed this now, and what they're doing is the Fed are going to go after real yields, and they've been going after real yields as their mechanism to make the economy stronger. And everything that you've seen has been evolved about. All of this whole situation has now just evolved into this idea to drive down real yields. So the question is what is real yields? And then you'll see pretty clearly, Dale, exactly how this works. You see it all the time. You read a Bloomberg article, you read, an FT article, you see someone on TV talking, real yields are down, the dollar's down, NASDAQ's up as a result. The question is what is it? The Fed need to influence inflation expectations. Governments need to influence inflation expectations. If you believe that Ferrari that you want to buy is going to be more expensive in 6 months' time, you'll buy it now. You buy purchases now. If you can change behaviors, if you can create animal spirits, you will create inflation. And at least that's the theory. So what we look at is a range of market-based inflation sort of estimates to measure inflation expectations. And inflation expectations breed inflation. If you have a look at these instruments here, the blue one's called break-evens, and the 5-year ones are break-evens. 5-year break-evens. And basically what these measure is the average expected inflation over 5 years or 10 years, and there's a risk and a liquidity premium built in as well. In fact, the Fed on this lower chart here have built their own model, 5-year forward break-even model, and it measures the expected inflation in the economy. You can see this around 1.65%. And you can see that inflation generally sort of follows. This is the one that the Fed actually target. It tends to follow this as well. So there is actually a tradable product in the market called break-evens, which measure inflation expectations. And it's the Fed's job and the central and the government's job to a lesser extent to create higher inflation expectations. This is everything now in central bank policy. If you understand why this is, so if you've got break-evens, what are break-evens? Well, you've got your nominal Treasury yield. This is a US government bond. This is a 10-year government bond here. So this has been sort of trading sideways, as you can see. It's trading 65 basis points at the moment. But for the last, since March, this has been moving sideways. What's actually happened is you've got there's also another product called the Treasury Inflation Protected Security. And what happens is this gives you cash flows which are related to inflation. The higher the level of inflation, the higher the cash flows. With a US Treasury, you get coupons, you get interest payments twice a year. With Treasury Inflation Protection Securities, those coupons or those income streams that you're getting will increase if inflation's increasing. So they hedge against inflation. Now, the difference between this normal US Treasury bond and the inflation protected security, the difference between the two, and TIPS, they're Treasury Inflation Protected Securities, you can actually trade these as an ETF. In fact, the Fed are actually one of the biggest holders now. The Fed have bought about 20% of the outstanding float. But if you look at the difference between a normal US Treasury and these TIPS, you get the break-even level, which is the expected inflation over 10 years in the US. So we can actually measure inflation. And so it's the job of the Fed to boost inflation expectations, because as we saw here, if you can boost inflation expectations, you can boost inflation. You can push inflation up to that 2% target, and you can get it above that level for a period of time.
Chris, if I may interject, actually the job of the Fed, I know what you mean, but actually, theoretically speaking, the job of the Fed is the exact opposite. The job of the Fed is to maintain price stability, which up to some recent point, it was considered to have stable prices, which meant more or less close to zero inflation. They've now moved the goalposts because they want to achieve something specific.
That's right. Yep. So they moved the 2-decade-old mandate to a new mandate of proactively driving inflation to 2%. And then
exactly, and they kept moving it. I mean, initially they said that it has to be positive, then they moved it again that it has to be positive but below 2%. Then the 2%, instead of becoming a ceiling, became a target, and now the 2% isn't even a target, because what they've been telling us is that we need to average out inflation over time. So actually inflation is over time, which they've never explained what over time means. Does it mean 5 years, 10 years, 20 years? It has to be 2%, which makes no sense, because if what you're afraid is deflation for every year in the past that has already passed and you did not have deflation, why is there a need to average that out?
Well, I mean, I don't see a problem with disinflation. I'm just going off their mandate, which is they want to create higher prices.
Actually,
so they want to create higher prices.
Is a positive thing.
Well, yeah, I mean, they want to get the economy going. But if you believe that they are proactively trying to get it to there, I mean, how are they going to do that? That's the question that everyone's asking. If you are going to try and create something that you failed to do for 20 years, that apart from a period in 2016, how on earth are you going to do that? So what we're looking for now is proof of how markets are responding through this reflationary situation. So what I'm just saying is that there is a way that we can look at this, and this is for people at home who've heard this idea of real yields. This is the mechanism by which we look at. So we look at tips, we look at the difference between the Treasury, and we can work out what the inflation expected is between the two. Now, if we have a look at the correlation in markets, and this is where it becomes interesting. This is going back to Dale's point. So we've got real yields, 5-year real yields. And if we measure them since April against the US dollar index, which is a basket of currencies, we can clearly see. Now, relationships like this don't last forever. But I think what's happening now is if inflation expectations are being driven higher or need to be driven higher, that's just going to create lower real yields, which is this Treasury inflation protected security. So we've got, it's not one for one. I'd probably say this correlation, if you're looking at a 10-day rolling correlation, has obviously picked up quite sharply now. But there's obviously periods here where the correlation breaks down a little bit. They're going in the same direction, but statistically they're not. It's not a perfect fit. But you can see that there is an influence here. Lower real yields are moving in line with the dollar. This is your point now, Dale. So we've got here 5-year real yield, so inflation adjusted bond Treasury yields, this white one. And what I've done is I flipped or inverted gold and also the NASDAQ. So obviously the NASDAQ's going up, but I've just tried to show the relationship between the two. So we've got real yields going down. We've got the dollar going down. It's now started to reverse because real yields have started to move higher. And you've seen this very strong correlation between gold and the NASDAQ. It is one trade. It is one big momentum trade. The question is in the short term, is what happens if real yields keep moving up? Are we going to continue to see the dollar strengthen? And is that going to see an unwind of the NASDAQ trade and the gold trade? And my view is that probably is more than likely in the short term. Now, why do the Fed want... If the Fed want to drive down real yields, and we know that's had a negative effect on the dollar, and we know that real yields moving higher has had a positive effect on the dollar. If we have a look at this chart here, we can see the Citigroup Inflation Surprise Index, and this obviously goes up if inflation's beating expectations and moving in the right direction more broadly, and that's the blue line here. And then we've got the trade-weighted US dollar, which is the green one. I've inverted that to show the relationship a little bit better. And you can see, it's a bit messy because one's more of a higher frequency situation, but you can see here that I've put the dollar with a 3-month lead, and if the dollar's falling, which is the green one here, it's actually rising. It's actually falling at the time because I've flipped this upside down. You can see this is actually a falling dollar has had a positive impact on inflation surprises in the US.
It always has, doesn't it?
Yeah, I mean, I think that's exactly right. So if you know that driving down real yields has a positive effect on the US, has a positive effect. Driving down real yields has a negative effect on the dollar, and a negative dollar has a positive effect on inflation. Why not go after real yields? The other thing is that it's actually really good for the world. I mean, not everywhere. I mean, you've started seeing the ECB now start talking down. It's, the ECB economist there, Mr. Lane, gave us an indicator above 120. But you can see here the trade-weighted US dollar on a year-on-year change basis. And again, I've inverted this against world trade volumes. And you can see that there has been a relationship of sorts at some stage where a weaker US dollar has actually benefited world trade as well. So generally, you've actually seen a situation where a weaker dollar will tend to sort of drive world trade. And so on the whole, because commodity prices are going up and various factors, a weaker dollar is generally good for the globe. That's why we like reflation. Have a look at this chart here, because this is kind of what we need to see. This is where we need to go from here. Okay, so what we've got is we've got the 10-year Treasury, and that's telling us a story in itself. And then you've got, as the markets have come out of their March doldrums with fiscal stimulus and various other factors, you've seen inflation expectations, the break even, which remember is the difference between Treasury inflation protected securities and the government Treasury. And that's been moving higher. So it's copper, the orange line. You've seen oil prices moving higher. They've sort of stagnated a little bit now. You've seen in the S&P, you've seen the cyclical sectors outperforming the defensive sectors, and that generally happens when you come out of, into a new reflation, into a new reflationary cycle. Okay. And so you've seen this all moving up as one trade, and that's kind of what we've been doing. Why? Because real yields have been moving lower. It's a reflation trade that's been working. The question is it's now started to be called into question, as you can see. Copper started rolling over a little bit. You've seen the defensive sectors starting to outperform. Break-even rates have started to fall a little bit. How much more has that got? If that does start rolling over, then I think in the short term, you could see a situation where that dollar continues to strengthen a little bit. You could see a little bit where, some of the reflation trades in the equity market may struggle, such as the NASDAQ. And I think that's something that we're watching there. So this is all one trade. And what's the central focus here? It's reflation. Yields. And it's driven. In the currency markets, it's really interesting.
How long could the Fed keep the 10-year in that rectangle, Chris? I mean, well, this is, that rectangle, looks like an EKG of someone in a coma. I've commented. So I was wondering, how long can they defend both the upside a little over 80, and we've had plenty of reasons for it to, make new lows. Even with the COVID thing, and it doesn't. So are we just going to move sideways? Are there bond vigilantes that could reawaken and do something about this?
So what's going to happen now if financial conditions tighten, which is that chart I showed you, then I think we'll start hearing Fed making more noises. But we've got a Fed meeting 2 days after the election. It's going to be a non-event. But if you go into the December meeting, it's my base case that I believe that we're going to see some fairly big action coming from the Fed. I think they're going to show a much more cohesive force. Steve made the point that the Fed are all over the place. And I think that's why the S&P's pulled back 10% recently, is because they're just all over the place. And I think they need to be a cohesive message. I think what happens in this situation is we will see the Fed increase their bond buying, and I think they'll also increase the duration, i.e. what the length, the maturities that they start buying as well. And the reason I think that is because the data's started to fall over now. If you look at the fiscal impulse, this is one from JP Morgan, we can see the fiscal impact that we had. That really increased their projections, that starts to dissipate. If you have a look at the real-time activity indicators from Jefferies, they did a really good one. You can see it really pushing higher. If we don't see a phase 4 fiscal stimulus, which is currently being debated, and given that the employment benefits run off fairly soon, we're going to start seeing GDP and personal income start to pull back a little bit. If you have a look at these break-even levels, which is the orange one here, the inflation expectations, as I say, moving higher, and they've sort of correlated with an improvement in economic data, an improvement in data beating consistently. If data starts rolling over from here, which we suspect it's going to, because a lot of these stimulus measures are going to roll off, then inflation expectations are going to fall. And that's just going to tighten financial conditions as we go into the election, and we're going to see volatility in the election. And then that's when the Fed start giving us the idea that they're going to do something big in the December meeting, and we start seeing that reflationary trade coming on. But the point being is now is that there's only so much the Fed can do. If we really want to create higher data and stronger data, which we can see, we can prove here, has had an effect on economics. As you can see here, this is the white line is something that everyone can have a look at. You can go to the website, New York Fed website, and they create this weekly economic indicator, which has all these various factors here. And as that's moved up, you know, you have seen break-even levels moving up as well. So average inflation expectations have moved moving up, and that's been one of the parts of the reason why real yields have moved lower, and that's why the dollar has fallen. So if we do see a situation where this starts to roll over again, you know, that's going to have an implication there. So it's the data. Now, how does data get affected by central bank policy? It's very hard to do. And that's why we need fiscal. We need more fiscal stimulus. And that's why, you know, I think I'm sort of running out on time at the moment, but I've got a big playbook on what's happening with the election, because I think fiscal stimulus is everything. And I think a blue wave would be significantly dollar bearish.
That means taking over the Senate too, presidency and the Senate.
Well, so we know that the economy needs more stimulus to get inflation expectations higher. If inflation expectations are getting higher, then we know that real yields are going to fall. And what I've done is I put together this playbook here. Blue wave, that's where they, you know, we get Biden in the White House, we get them in the House, and also the Senate. And me, in my view, that's actually going to be maybe initially strong for the dollar, but I think over the longer term, we're going to see significantly lower real yields. And I think as a result, the dollar will go on a weakening trend. That will be very, very positive for the S&P. I think that'll be very positive for gold. And I think that will be modestly negative for crude. The base case is we'll probably get one of these two situations here. And then, you know, obviously we'll see what happens with real yields in that situation. But what we want to also have a look at is in the currency markets. Is have a look at the correlation here with that reflation trade. So we've got the correlation here between real yields, so inflation adjusted bond yields relative to Aussie yen, Aussie CAD, Aussie dollar. And you can see here that over the last 1 year, the 10-day rolling correlation is negative 0.84. So in layman's terms, what that means is is that 84% of Aussie yen can really be explained by by lower yields. So as we're seeing real yields falling, Aussie yen's been moving higher. You know, so 84% of the variance in Aussie yen can be explained by this one variable. So if we do if we see a situation where the government comes in and they promise fiscal stimulus, economics start improving going forward, then what's the currency statistically? This is not me just coming out and plucking numbers out the air. This is actually using, you know, statistical information. Aussie yen has, for every 1 unit of a fall that you're seeing there in the real yield, you know, this has moved up by 0.84. And you can see Aussie CAD's been the next one, Aussie dollar. So these have been your reflationary trades. So if the Fed can come out in December and start really going after their mandate, which is a big if, and that needs to be backed up by fiscal, then we can actually see pretty categorically that these are the trades which have worked and will probably continue to work. On the other side, you know, if we see the dollar continue to rally and we see real yields rising and inflation expectations falling because economic data is going to deteriorate, which is my base case for the next couple of months, then these are the trades which will probably come unwound as well pretty quickly. You know, what I can have a look at, Dale, and I can get pretty hardcore about this situation, is have a look at real yields on a relative basis, you know, and this is what we look at in the strategy basis. So, you know, what we saw is the relationship between Aussie dollar, which is the blue line here, and Aussie real yields minus that of US treasuries or real yields in the US. And what we could see that you go back into the beginning of the year, into late to 2019, is that Aussie government bonds on an inflation adjusted basis traded at a discount of about 50 basis points less than US treasuries. But as the Fed have come out and lowered rates down to zero, and they've done all these other factors that have been more stimulatory, we've now got a situation where Aussie real rates, real returns in the government bond market are trading 47 basis points, or nearly 0.5% higher than that in the US. And you can see that that shot up shot up really well. And that's put valuational support into the Australian dollar. So not only have you had that reflation trade, what's the best way to trade reflation? If you're seeing commodity prices moving up because the dollar's weakening, because equity prices are moving up, people are feeling richer, or at least that's the perception. What's the best way to play reflation? It's through the Australian dollar, because commodity prices are moving up. It's a commodity currency. China's doing quite well on a relative basis and all these factors. But now what we've also seen is this really big mechanism in the US, which was carry, the idea that you could be paid to be holding US dollars. The Fed have completely removed carry from the market. They've taken all the carry from the market. So all this idea of carry means income, whether you're in the bond market, equity market, or in FX, it just means getting paid, getting income. And effectively what's happened here, if you want to use this as a carry vehicle, is that you're actually getting paid more on a real basis, an inflation-adjusted basis, to be in the Aussie bond market. And we're not talking about cross-currency basis swaps and hedging costs and bits and pieces. But you can see here is what the Fed have effectively done is they've pulled down real yields so substantially so far that it's making other currencies look attractive. You can see that here. So have a look at this in Europe. You can see this period here where the difference between German and US real yields was quite highly correlated with what we're seeing in euro dollar. I mean, obviously, if I was to hone in on this area here, you'd see that relationship was much stronger, and also much stronger here. And what we've seen here in this part here is the euro dollar's blue, and you can see here this is the inflation-adjusted German Bund minus the real yield in the US. Is that German real yields have really moved much higher. I mean, at this stage here, we were German 10-year real yields, inflation-adjusted yields, were negative 200 basis points. They're now negative 26 basis points. So what the Fed have done is they've taken down real yields so substantially relative to other countries, because there's been this big reflation trade which has boosted inflation expectations. They've kept nominal Treasury yields very, very flat. And that's really created this outperformance here. So you've seen this situation where all the carries come out the dollar. And you could almost argue that the dollar's cheap on this basis here, and I don't think it is. I think you'll see convergence. The other aspect, of course, is if you look at inflation surprises in Europe, and you look at it relative to the US, which is this bottom pane, and you can see as the euro's been strengthening, that inflation surprises have started really outperforming relative to Europe. So this is why the ECB are a bit worried, because if we do see real yields continue to fall, and as I say, everyone's talking about that, then the chance of creating inflation in the US is significantly higher than that in Europe, and that's something there that we're looking at. If we go in Japan and have a look at relative rates differentials that we're seeing there, so you've got the white line there being what you're getting as a real return in the US Treasury market relative to Japan. You can see it's collapsed. So at one stage in 2019, you had an advantage of about 150 basis points. So if I was an international fund manager and I'm looking for a real return, an inflation-adjusted return, which of course we do, I'm getting 150 basis points in the Treasury market relative to Japan. That's all just completely gone. And now we're actually getting negative, we're getting penalized, because real rates in Japan are actually positive. So why do we love the yen from a valuation perspective? Because they've got positive real rates, because the Japanese cannot create inflation expectations, because the Japanese cannot do anything with their bond market. You actually get a positive real return. It's very, very positive. So anyone who looks at their dollar yen chart and says, this, we've just seen this massive rally in the NASDAQ, we've seen this massive rally in the S&P, which would traditionally be really good for dollar yen. Why is this broken down? Well, it's because people want the yen, because you can get paid positively. Now, what I've actually done, and again, this is getting a bit hardcore, but I think it's really important for people to understand this. If you're understanding fundamentals, if you hedge your US Treasury exposure using these things called cross-currency basis swaps. If I'm a Japanese fund manager, and Japanese funds have some of the biggest funds in the entire world, if I go and buy US Treasury and hedge that exposure back into yen, I get a 21 basis point return. 24 basis point return. But if I compare that to what I get in Japan, which is pretty much nothing in the JGB market, it's a positive return. So what you've got Japanese funds is buying US Treasuries and then hedging that exposure back to the yen. So again, you've got to ask yourself, why does the yen not sell off? They're talking it down. You've seen this massive rally. It's because Japanese funds have increased their hedging ratios. You've got this situation where you've got positive real yields in Japan. It makes the yen very, very, very attractive. Any rally that you see, that I see in dollar yen at the moment, I want to sell it because I know.
Like last week, Chris. Last week there was a recovery in that.
Well, I'm looking at levels. I mean, absolutely. I mean, I think right now, as part of my framework, I'm starting to see signs that that reflation is starting to abate a little bit because economic data has started to roll over. But there will be a point, I think, post the election where the reflation trade will go on. I'm not talking about right here or now, but I think for 2021, what we've seen in this period where real yields are going lower because inflation expectations have been going up, and this reflation trade has just been centered on real yields falling and the dollar weakening, and then everything else has been a derivative of that. Stronger gold, stronger NASDAQ, stronger growth stocks, cyclicals outperforming defensives, copper working, lumber working, all of these things have been working. Why? Because inflation expectations have been pushed higher, economics have improved, and all of those factors have worked really well. And then you've got the fact that the US real yields are falling on a relative basis relative to all of these other factors. And so for me, that's everything right now. And this is why when I look at all these factors, when I talk to retail traders and they're saying, oh, I'm trading fundamentals, I'm like, but you're trading the wrong fundamentals. You don't know what you're looking at. You've got to really understand. And I'm not saying this. What I'm saying here is absolutely correct. But I'm looking for correlations. I'm looking for relationships. I'm looking that the market is actually looking at this. And I'm saying, are you looking at real yields? And they're saying no. And I'm like, well, why not? What are you looking at? And so this is why I think a lot of people, when there's trading and starting out trading, when they start using fundamentals, that they're generally looking at the wrong thing, which is kind of why you look at price, right? You have to look at price, you have to look at flow, you have to look at all these other factors that are happening, because it's the aggregation of all of these behaviors that are taking place. Because fundamentals, when it comes to understanding what's actually making these things move, it's very, very difficult to do, which is when I talk to clients and when I talk to people about this, we put this out in the research. But the idea here is that, it can be very difficult to understand what is actually making things move. Every week on a Thursday, there's the Japanese flow data, which the Ministry of Finance put out. We can all get hold of that. It comes out. Everyone gets to look at it. You guys, you can see what the Japanese funds are doing, whether they're buying foreign stocks, foreign bonds, domestic bonds, domestic equities, and you can see what these guys are doing. And it's part of the sort of flow process that you've been seeing. But for me, I understand that the Japanese yen is an incredibly attractive currency. Why? Because if we were to see a risk-off environment going into the election, volatility kicks up. We know that the Japanese yen is a great place to be in those risk-off environments. We also know that it really didn't take part in what was a really positive environment that we saw between March and recent times. Why?
True.
Because the Fed managed to bring down real yields, and you get paid to be in Japanese yen. They've removed all the carry, and so that's what we've been seeing. I want to sort of just touch on. Yeah, so this is really where we've been. I want to just touch on. I mean, just give me how long have we got on the presentation left?
We need to wrap it up here in a few minutes. Go ahead, Chris.
I just want to say, right, we need fiscal stimulus. We need fiscal stimulus. Absolutely. If we get, and that's why
I'll wire you 10 grand. Would that help?
I need fiscal stimulus. Let me tell you something about. Let me tell you something about the election. So you can the good thing about the Democrats in this is that they want to go big on the spending. I'm not saying that's I don't have a political allegiance, but they want to go big on the spending. The bigger the spending, the better. They get closer towards MMT. That's what it's all about. It's about deficit spending. The Fed then come in with and you may get inflation, and you may actually get inflation expectations, and that trade continues to work. What I'm going to say though is look into this election though, because if you have a look at the volatility structures, 2-month dollar yen implied volatility minus 1 month all-time highs, dollar CNH near all-time highs. For people who aren't au fait with the options market, implied volatility is the expected movement in a currency over that period, up or down. But it's anticipated movement, and you can trade that, and it's based on options prices. But what you're seeing is that 2-month expiry options on dollar yen are trading at a record premium. So markets are expecting movement here. If you have a look at dollar yen 3-month, you go this, and it gets even higher in the bond market. Higher. This is the really big one. You've got the election here. So this is the term premium of the S&P. So we're looking at put volatility. And I'll try and make this, for people who are not au fait with options, the options market is fantastic for giving us great color about everything. This is the election here. So the implied volatility in the S&P for put options is 30%. That's an annualized standard deviation number. But what's interesting here is that the volatility is rising into the election, but then it rises even more afterwards, going into the new year. What does that tell me? The markets are expecting massive movement.
Yeah.
But they're also expecting massive movement afterwards, and they're buying put protection afterwards because they think this is contested. They think this goes to a contested election, right? And there's going to be carnage on the streets. There's going to be civil war, whatever it's going to be.
Chris, I think there is another explanation for it. We know that there is a lot of stuff that is currently being papered over, a lot of real problems. And I think besides the possibility of a contested election, there is also the market's pricing in that some of the problems will have to come in the forefront following the election, no matter who becomes the next president, if it's Trump remaining or Biden comes on.
Yep.
Great presentation. Great presentation.
There's a minute. All I'm saying here is that the market's expecting movement into the election, and a lot of movement afterwards as well. So that's going to be something that we're looking at.
So we need to fasten our seatbelts, Chris, right?
Well, I think this is priced in. What actually may happen if we get an outcome, if we actually get an outcome on the day and someone accepts it, then we may see a massive relief rally. Let's just think that the market is priced for carnage here.
Right.
If we don't get that, if we get an outcome, whether it's a Biden or Trump, we may get, the market is telling me from the options, they're expecting carnage. They're expecting contested. Right. This is going to go to violence on the street, whatever it's going to be. If that doesn't happen, realized volatility is going to come in much lower. So this is really an interesting one. So I'll wrap it up. My view here is that what I've tried to explain very, very quickly is that for the Fed to achieve its three-pronged mandate, which is very, very hard to do, one, they need fiscal stimulus, and that won't come at the moment. It has to come from a strong government. It has to come from either a Trump sweep, or it has to come from a Biden sweep. We need strong government. We need a strong full Congress. I'm not sure if we get that, but we need fiscal. Economics improve, and then the Fed come in with their strong mandate, which I think will come in December. If they can boost inflation expectations, which we've looked at through break-evens, which is the difference between nominals and treasuries, we've seen that reflation trade will continue. Aussie CAD will work, Aussie dollar, Aussie yen, all of those things will work and continue to work. But if we see inflation expectations rolling over in the short term, which is what we're seeing now, it boosts real yields, great for the US dollar, which is what we're seeing now. So my view is that, and what I've tried to prove in a very short period of time, is that it's all about inflation expectations and what that means for real yields. And if real yields are going up, the dollar's going up, and a lot of these trades will be unwound. So it's all about real yields. It's all about the US dollar. And that's going to be really central post the election as well.
Thank you, Chris.
What a great fundamental presentation. I see why Pepperstone recruited you. So
Thanks.
really, thank you so much, Chris. I mean, I learned a lot. I'm mainly a technical guy, and you've given me some things to reconsider, especially my stance in US dollar yen. So thank you for your time today. And
We
my,
don't have time for questions.
And glad that we have an association.
Well, my view is that is you can have these fundamental frameworks, but you follow the technicals, right? That's the one part of the framework. The thing with the FX market is you've got a million different things that are aggregating into price. Real money accounts, hedge fund activity, leveraged accounts, all this kind of stuff, all aggregated into price. And I can come out of all these different correlations and everything, but you've got to follow the money flow. You've got to follow the aggregated. So, you've got to put those fundamentals, and that gives me the framework. Making money out of that is the next step, and that's where we go into a whole new presentation, because that's the framework which gives me understanding about what to look for and what to follow. But the technicals is so important. The money management, obviously, the position sizing is what you're doing with trading in those situations there as well.
Okay.
But yeah, if anyone wants to get in touch with, I was going to say, if anyone wants to get in touch with me, there's my Twitter handle. I do a daily wrap for clients and for other people as well. You can see all my details there. We're doing a set of webinars as well, which may be of interest to people there, touching on some of these factors as well. So do reach out if I'm sure we've got a lot of questions around what's just been said. It's been a whirlwind.
Unfortunately, no time for it. Thank you very, very much for being here, and have a wonderful night, because it's night here, right?
Yeah, Chris Weston at Pepperstone.
Thank you very much. Take care.
All righty. And now my trading warrior brother, Ashraf Laidi, who I've had the pleasure of interviewing a few times, maybe a handful of times, and always a combination of compelling ideas about the market, and we always have a good time talking to each other. For those that don't know Ashraf, he's an independent strategist, trader, founder of Intermarket Strategy, author, so he's written a book, Currency Trading and Intermarket Relationship. He was with City Index for a long time, where he focused on global macro environments and foreign exchange, and he could be found at ashraflaidi.com, which he created in August of 2008. My trading warrior brother, Ashraf Laidi, great to have you here, buddy.
Dale, how are you? Thanks for having me. Thank you, Steve. Thank you, Joe. Dale, how are you? And how's your health, by the way?
I'm breathing in and out and trading and, surviving COVID. So all is good, buddy.
I hope the more QE the Fed does, the more equivalent it will be for medicine for you, no?
Okay, well, I'm injecting reserves right now, so I appreciate you coming here on a Sunday to be with us, and I understand you have a topic that you want to cover, and
let me just thanks for having me. Let me just try to get this right, because I'm going to share this screen. I hope I share the right screen, because I've got the PowerPoint presentation.
Okay.
My voice is good?
But yeah, very good, clean.
Yeah, I'm going to do the PowerPoint presentation, and I also want to be able to go to Bloomberg when I wish to, because I don't want to bore people with a static PowerPoint slides. I want to be able to go to a live chart, even though it's a Sunday. So hopefully when we have time. How much time do we have? It's 2:10 p.m. right now. How much time are you giving me?
45 minutes.
45.
Yeah, another 40, let's say, left. Yes.
You guys, man, come on. It's a COVID generation. You guys got to give more.
I'll tell you what, Ashraf. Whatever is left, we can resume on a face webinar. Right, Dale?
He's always welcome. Yeah.
Absolutely.
All right, thanks. Yeah, I think 45 minutes we can do it. So yeah, because I want to, So let me just share the screen, and which screen should I do?
Nice microphone.
Sorry?
Nice microphone.
Oh, thank you. Thank you. I think I need to add the little sponge thing that makes the voice softer, and maybe we can get a record with the Grammys and stuff.
Yeah.
Let me do this one. share. Can I select more than one?
One at a time.
One
at a time, Ashraf. Yes.
Okay, okay. Oh man, Zoom, they're so way behind.
There you go.
So you can
There's
see
your
the
slide.
PowerPoint now?
Got it.
Lovely. Excellent. All right, and you can see, let me see this.
Applying
this you can-
intermarket fractals contents now.
And you can see
Second
the
slide
contents
is up. Yep.
All right, good. What about the chat? Can I see the chat if there's anybody has a question or no? I will not distract myself with that.
I could see the chat.
You can see the
It'd
chat.
be on the
Okay.
right-hand side of the screen, and I
Lovely.
could relay questions if
Excellent, excellent.
when they come.
Right. Okay, very good. Okay, so let's kick it off here. So let me just start with something here. I saw the guest list of the Trader Summit, the speakers. All right, and you've got some guys with some compelling reasons why the dollar is going to go down, why the Federal Reserve's cushion and absorb, purchases and so on and so forth is going to be awesome enough to absorb the risk aversion. And then you've got some other people, probably who were not invited, but other people who the listeners are aware of, who talk about things like the milkshake theory, where basically the risk aversion and dollar financing, and when the next storm hits, there's so much money out there, and there is $56 trillion worth of dollars outside the system that the Federal Reserve cannot turn off the fire on, and therefore the dollar is going to go up. And all of these are compelling reasons. Then you've got the deflationistas, the people who believe in deflation, and gold will actually be boosted, but it will actually be good for the dollar, and so on and so forth. And the listeners, the attendees of these summits and of these PowerPoint presentations, they've listened to the smartest thesis for both ways. If I meet you at a wedding or an airplane, I'm going to give you 5 compelling reasons why the dollar is going to go up in the next 4 months, and I will give you 6 or 7 or 5 compelling reasons why the dollar is going to go down or up. All these are smart people. They're all smart people, and Real Vision has been an amazing revolution. They've got great guys who argue for everything, for why it's up, why it's down. Okay, so because this is 2020, so what I am going to do, I'm going to try to incorporate the thesis that I give based on cyclicals, based on technicals. But then what do I do in the middle of a move? We can all predict, you can all predict a dollar rally of 5% or 4% or a decline. But what do you do when you're after that? What do you do when you put close, when you put sell, when you close, when you get money in your trading platform? What do? Do you boost to your friends, to your family? We can all, lots of us can call tops. Lots of us can call bottoms eventually. But then what do you do afterward when you've made your 7 or 5%, when you're in the middle of the range? So that's what I'm going to try to take you through a voyage. And I know there is something called the top-down approach, which it's an expression that's been used left, right, and center. I remember, I was my days when I was in the, I was working for a United Nations fund, and then we had these guys, Goldman Sachs Asset Management, JP Morgan, Credit Suisse, and they wanted us to be their client, and everybody was having one sexy presentation after another, and they were talking about the top-down approach and the bottom-up approach. And my boss said, "Okay, stop. Stop this. It sounds like we're going to do something else. This top-down approach. I don't want to use the word, but he said it seems like we have to be over 18 here. Stop trying to seduce me with these things and tell me how you make money." And I don't want to seduce you. I don't want to use all these fancy points, because I want to tell you how I use my approach and how I use my approach. So let's get through it. So basically, and I know these are fancy words that you want to draw somebody to a presentation, so you stop them from being with their kids on a Sunday, right? So you say fractals and FX, and don't watch the football game don't go shopping. Listen to this. It's about fractals. It's sexy. It's good. But I'm going to try to actually, and I will put it down to work. So fractals in trading, they're recurring patterns that are self-similar across different scales. You know, they have, you can find them with different sizes, but with the recurring pattern. They're created by repeating a simple pattern or shape presenting order in otherwise chaotic, noisy price indicator chart. And I know a lot of you, a lot of attendees have seen me doing this in other summits, other PowerPoint presentation. I did one in New York, in the New York Expo, but a lot has happened since then. So let's go. So building your own top-down thesis. Let it come to you. Don't force it. Don't force it. And I know a lot of technical traders, they say, listen, man, I don't know. I'm not smart enough to know what the Federal Reserve is going to do or what the ECB. I just look at a chart. I call it as it is. I look for my indicators. I get in and I get out. And that is valid. And that is what you, the listener, want to hear. Because you, when you take a time off on a Sunday, you want to hear, well, I don't want to, but a lot of them want to hear a simplified approach. Very simplified approach. I don't want this guy, Ashraf Laidi, he wrote a book about intermarket analysis and so on and so forth. It's too complicated. I don't want to go to university. I just want to know how to buy low and sell high. That's true. But you have to look at the big picture, and I'll tell you why, before you start to, you know, stack up and buy low and sell high and when to get in. So this is a chart. And again, this is the least technical of the charts that I'm going to put. And then I'm going to go into technical charts like these and like that. But in early 2017, when everybody was saying, you know, a few months after Trump won, everybody said, well, you know, Trump is going to be good for the dollar because he's going to bring money home. He's going to be, you know, tough on foreign, you know, competition and so on and so forth. And the dollar reached a top basically January 2017. And if you want fundamentals, we'll give you fundamentals, but this is not going to be about fundamentals. This is going to be technical, and it's going to be intermarket technicals and fractals. And how do you put it to trade? And I will show you, because I'm all about examples, real examples, how basically these things work and how we made money, but how we lost money too. But this, just to give you an idea, this guy called Ronald Reagan, he launched a war versus Japan, a trade war. And that coincided with the top in the dollar, 82 to 84. Then you had Bush versus foreign steel in his second term, not the first, actually in the middle of the first term. And it was actually February 2002 when the dollar peaked, because he decided to announce a war on Brazilian steel. Some of you remember, some of you don't remember, some of you don't care, because I just want my signal to tell me, my RSI to tell me this and tell me that. And you should do that. I'm not talking down to it. You should do, because I'm going to show you how the RSI breakout, how to apply RSI breakout models after you've made this thesis and you sounded smart to people and those who go on TV. I had my fair share of going on TV and, you know, in the US and here. But now it's about being right and making money. It's not about sounding smart. But
we all agree.
But I want to do both. I want to sound smart, but I want to convert it to money. And I'll tell you why these long-term things are important. So basically, if you want, you know, the fundamentals, listen, this is not 1980s. You know, US trade actions are no longer going unanswered. The most recent example was Bush having to reverse the 2001 steel tariffs after the EU threatened, blah, blah, blah. And the same thing happened in China. And now China is not like the Europe of 1980s. China is not the Koreas of 2001. We're talking about, you know, funny names like TikTok and stuff like that. But, you know, the game has changed. And so let's just go. Making your way down from that chart. Basically, if you didn't get the picture, you've got lower highs. Now, here's an example. After I did this, 2017 top, okay?
Yeah.
There you go. This is another analog. This is an analog. March 2015, okay, October 2000. So the red and green chart, October 2000.
Right.
And the other one is February 2002. And this is similar to January 2017. And this one, around 2001, is similar to December 2017, 15, and March 15. And basically what happened, if you're copying a cheat sheet, so when I did this chart, Dale, this one, we were here. We were here. And the chart doesn't lie, 2000, we were here. And obviously this thing went down. It didn't go down because Ashraf Laidi came out with this thing and he predicted about steel and this and that, because if you like to cheat in school, you just cheat with this. And you look at the analog of 2002. 2002, what happened? We fell. And that was January 2017. And we all know that January 2017 was a stellar year for everything else but the dollar. It was a bad year for the dollar. Now, then everybody's going to ask me, okay, Ashraf, we know always you come in on Twitter and you say, well, the dollar's going to fall. Well, how did you do in 2018? How much money did you lose? You're right. So let's go. So guess the next chart. So this is an exercise that I do with people. I show them this. Oh, wow. He's taking us, well, I don't like it when Ashraf takes us to this long-term stuff. But this sounds interesting.
I do.
And you have an idea what it is. So basically, this is a dollar index 16-year chart.
Nice.
And the highs, 71 was the collapse of Bretton Woods and so on and so forth. But 69 was actually when the dollar was still holding and the market was still closed, fixed rate and everything. But there was the surge in nations' demand for the dollar gold exchange. There was, the gold. All of these guys were saying, listen, it's time to pay up. Things didn't really break until 71 or 73. But 69 would think, and 69, 85, you do your math, Plaza Accord, 2001, the top, 2017. But the key is that this did not go up. And I'll show you the live chart later on because this looks ugly. Well, you don't need to take my word for it. We all know where the dollar index is. It's here. It's a 92 or it's a 94, but it went to 93. Okay, so it's here. So this chart works and the cycles work. And if this doesn't wake you up from a boring, tired Sunday, then I don't know what will. But actually, no, I know what will because this is just a warm-up.
I'm awake, Ashraf. I had a few cups of coffee. So it looks like that cycle work bottomed, and we're probably not due for a high for what, another few years, right?
A few years. But that's not enough. How do I make money in this? Don't tell me this. This is great. Don't tell me about the birds and the bees and the Big Dipper and what happens tomorrow. Is it going to rain or not? Don't tell me how the stars are aligned. You're not trying to seduce me. That's it. I'm your client. No, trying to tell me how to make money. So, and by the way, I tweeted this in May 2nd, 2020, just to, tell people this is, why is it important? And I'll tell you why it's important. I'll tell you. So when you're here, so this is basically top-down approach. So you've got the three top here, all right?
Right.
2000, there's a band called the Four Tops. So these are the three tops. So 2000, 2001, 2002. Then you've got 2015, 2016, 2015. And this baby never looked back. But I'll tell you where Twitter goes crazy and CNBC goes crazy. The dollar boars and the dollar bears, they go crazy. Everybody goes crazy. And a lot of people lost money in here, my dear friend Dale. Here, March 2020. Everybody who got hurt, long dollars in 2017, they said, this is it. Dale, I will give you £5, $5 for every person in your FX street who told you that dollar index is going to break and it's going to go towards 105 and 110. I will make you a millionaire if I give you 1 pence for everyone that you heard in Forex Street and Essex Street and Playboy and everything that will tell you that, oh, the dollar is going to break because the market is going to crash because we have a depression, because COVID, because the dollar is the only game in town. You don't need to say it. I'll say it for you, Dale. March the 6th, I was in New York. I took a video in front of the Federal Reserve Bank of New York. I had and that famous weekend when Saudi Arabia said, screw you, we're not going to cut production. Go to hell. Remember that Sunday, March 7th, and the market and oil crashed 40%? and the euro went to 115 and then it went towards 108. And everybody said, this is it. This is the moment I've been waiting for. My FXC, my UUP, it's going to 105. And I said, no, it's not. I said, no. I said, no. And I was wrong for a bit. And I lost money for a bit. But I'll tell you why. I'll tell you why. I stuck to it. All right. Is it too much shouting or no? What are the people saying in the questions? I can't
someone's smiling. They you know, love this guy. Someone's saying I have to get you on face as soon as possible.
Okay, no, I don't want these comments. I just want, oh, that's too much screaming for me. I can't.
No one has complained about your screaming. Good so far. Joe said, you know, you have a witness to your story. What the story you just told. Joe Perry was there in New York presenting the same day as you. We work with Joe, so he remembers that. So there you go.
Guys, my
you brought we have a witness.
I have 15 minutes. Oh, listen, I don't want to be booted out. Okay, sorry to cut you, Dale.
That's all right. We have a witness.
Because there is a lot to put in, and it's very important. And this is how to help traders, how to build the thesis, and how to be confident. When you have a thesis and it's going against you, and you're losing money, if you're a retail trader, you don't have a lot of experience. When do you say stick to your guns? But you're an amateur. What guns are you sticking to? Versus being too stubborn, right?
Fine line.
Being too stubborn. What do? Stick to your guns if you're comfortable with it. If you have confidence. I started trading 4 years ago. Is that enough? No, it's not enough. It's not enough. Listen, I'll tell you something, and I'll be very serious. So you've got guys, let's say, and I'll take two guys. Let's say Brett Johnson. Brett Johnson, milkshake theory. He says the dollar is going to go down. I'm not sure when. And then you've got, and he's got these amazing theories. I don't agree with him. I'm more of the school of Lynn Alden. I believe her name is Lynn Alden.
Yes.
You know, I like her case, but I believe more in her case about the dollar will actually pull back and it will end up lower. But it's not about taking cases. It's about what. It's not because she sounds more convincing. Brett sounds more convincing. It's how do I use my own instruments analysis to fit to which story? Then you have a third camp. Third camp will say, I don't need to be partial to when the dollar, whether the dollar is going to go down 5% or it's going to go up 10%. I'll just trade it as I see it, because you know there are some guys who use false modesty. They say, I don't know much. I'm not smart. I'll just go into my chart and I look at this, and then I don't know what the Federal Reserve is going to do. Some of them are truly modest, and some of them they like to play the false modesty, and they say, I don't know what the Federal Reserve. That's there. They don't know. The game is. I just look at my thing, and a lot of people do that. But I'm not going to claim that I will do that. I have my thesis. You have to build to it. And here's the thing. So when you have this convinced me that this is going to go down and this is going to repeat itself. And I'm going to show you countless examples of fractals, not 5-minute fractals, not 10-minute fractals, but something that is strong enough for you to hold. Strong enough for you, Dale, when you are losing money and you're about to be margined out, and you say, man, do I put more money and I stick to my thesis? Do I put more money and I stick to my thesis? Or do I'd
have to ask my wife first.
Yeah. Oh, yeah. Or ask my wife.
Before I loaded up my account again, right?
Just like boiler room. And hey, who makes decisions? You or your wife? Anyway, so yeah.
She does.
But, you know, so let's go. All right, then came along 2020. So 2020, this baby came here, and this was tested.
What is that, a diamond?
That's, yeah, you call it whatever you call it. I don't want to say, oh, Ashraf is the king of diamond trading. But it's, you know, oh, he says, oh, keep me away. Don't listen to anyone who does diamond fractals.
Oh, it could be a ruby.
Yeah, but whatever. Call it diamond. Call it whatever you call it.
All right, I'll call it.
You'll get your 7-year-old kid, and you'll say it is similar. So basically... So this is early 2020, and here's where so then you go to the monthly, and then you say, guess what? not only the candles are similar, but the way the 55-month moving average is being respected and is being broken is similar, and the trend line, and the RSI. Okay?
Yeah. Yeah.
Now, did I get your attention?
Got it.
After 15
Oh, it's a
minutes of screaming.
trapezoid.
Sorry?
It's a trapezoid, Randall said.
You can call it trapezoid, call it whatever you want. After 25 minutes of shouting, I've gotten your attention. Now,
right.
let's apply this to work, to the trades. All right?
That's the key.
But before I do that, look, gold weekly, 1998, 2004.
Yeah.
Uh-oh. And then February 2020, weekly. Oh, my God. So this is good. This is very similar. 98, all right? And then 99, the dollar was the only game in town. All the money was going abroad. The technology bubble was pushing up. Stocks were going up around the world, but money was going into the tech and blah, blah, blah. Then the 99, gold pushed up, pushed back down. 2000, the recession of 2001 came in, started actually 6 months before September 11, 2001.
Yeah.
And because when we went to 2001, September 11, the US was already in a recession. It just wasn't in the books. But look at this similarity, okay? Now, and this chart, my deal, Dale, is an old one. It's from February 2020, okay? It's not a new chart, it's an old chart. But when gold was 1673. I got this PowerPoint from this slide from an old presentation, but just to give you the idea. Now, we all know where we are in gold. And I'm going to show you how I called the top in gold and the top in silver on August the 6th. I will do that if I have more time. Okay? And I should have more time because this is very important. Because what I'm going to do in the next few slides, I'm going to take how I mobilized all the troops into putting my money into selling dollar and buying gold, even though I got hit a few times, a few false dawns, which was in March and April. So here's the thing. Integrating event risk to technical analogs. So I'm going to take you back to the dollar, but this is just for you to know. Sterling dollar example. A lot of people may have heard that I was very bullish in cable, sterling. Not because I know what the hell's going on because I live in England, but because I was using something. And here is something for you guys to look at. So this is the 1992 ERM exit crash when the sterling exited out of the exchange rate mechanism. No, it's not the Eurozone. No, it's nothing to do with the Eurozone. No, the sterling was never part of the Euro. No, 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 no. But the ERM. I'm not gonna explain it because we don't have time. But basically, sterling crashed because of a European related event, crashed 20%. It consolidated, came back down, and it broke. A very similar event. A European-related crash in sterling, 2016. Baby,
right.
If this is not fractal, if this is not an analog, turn off your computer, go do something else, go for a jog, go for coffee, go watch the football game. Because if this is not a 30-year analog that tests the time, go home. Okay, fine, you got my attention. How do you trade it? How do you trade it? Okay. So, all right, and need I not to tell you that cable went towards 135, and actually it's 134.80 because we did tell the client why it's going to go to 34.80 and it's not going to go to 35. So this baby worked. Now let's take you back to the dollar. And this stuff I've been sending this to clients and PowerPoint presentations, the one that matter, every other few months. And if that's not enough for you, well, that's enough for you. So 8-year cycles in sterling. You got to keep these things in your pocket because when you're buying the thing and it goes down against you, when you're going to be margined out, you stick to your guns and you use things like this and things like this. Let's do the math. 1977. Yeah, did you know that sterling and the UK got help from the IMF? Nobody knows, nobody cares. 77. 77 plus 8, 85. 85 plus 8, 93. 83, 2001. 2000 plus 8, 2009. 2000 plus 8, 2016, 17, same thing. Yes, we did come back towards 114, but we did not hit the low. Did we break the low? Now, 2016, there was some trading platform. I was trading with FX Pro, and I had, actually, sorry, not an FX Pro, with the House of Borsa, really, truly, not a market maker, and straight through. The guy was, I got 114 that day. 114. Let's get to it. 114. Bloomberg gave 115, 116, I think, you know, that famous day of October 2016. Okay. The referendum was June, but the crash, it was 116. I got 114. But, and that's important because September 3rd, the birth of my, you know, third kid, September 3rd, 2019, that's when we had a big low in sterling dollar. And then we had another big low in March or in April. But the relationship held, my friend. We did not take to new lows and the cycle held. All right, let's get back. What it means for euro dollar, because everybody trades euro dollar. The world's top traded FX pair. Once upon a time, and I wrote a book that I wrote 2008. FX, the euro dollar is very important. Yes, the USDX is important. The euro dollar account for 27, 25% of the online FX turnover market, which is around over 6 trillion, and it's important. Whoa, what is this? Wait a minute. Aha. So this is the Euro trade weighted index. So this is basically in around May 2000. So this is euro dollar inverted head and shoulder. And 98, and we know, and then we just went to 110 because the thing went to 120. Never mind, never mind. What is this? Give me something I can trade in my broker. What on earth is this? Who cares? This is the euro, this is the equivalent of the dollar index. This is the euro equivalent. If it's showing you this inverted head and shoulder, which you only find in page 5 of textbook of patterns of John Murphy's, 78, or you find in page 79 of that thing called stocks and commodities, you only find it in textbook. If you find this, it's going to break and you will apply it and you will apply it to euro dollar. Now, and this is an old chart. Now, the other great analog, for those of you who like fundamentals, I can analogize, technicalize the fundamental. Are you sitting down or are you sitting down? Are you sitting down or are you sitting down? And I mentioned this to Dan Gramza, who was at the New York Traders Expo. You know Dan Gramza, right? Yeah. So he gave me a video, on New York Expo, and I mentioned this to him, and he was paying attention because he knows his FX, but nobody else could understand what I was talking about, and it's frustrating. And I was using those bad habits where I would raise my voice in order for people to understand, but I realized that that doesn't work. You don't raise your voice to understand. You just show the chart, or you spend 5 hours. So I'm going to do it. So this is euro dollar weekly. This is the 10-year minus the German 10-year minus the US 10-year. Okay. Yeah. And basically German 10-year minus 10-year is the spread. As the spread worsens, euro dollar usually goes down. As the spread shrinks, meaning there is less disadvantage for Germany, it's German, and it's not US minus German, it's German minus US, because this is euro dollar and not dollar euro. Right. But that's all great, right? But here is where the money comes. Here is where your confidence comes. Here is when you're losing money and you're saying, damn, my thesis is not working. Where is it going to happen? Well, guess what? So this not always work. It's not always correlated. And even the big, nice global FX strategists in the big banks, they said, well, yield spreads are being applicable. Oh, now it's not yield spreads. Now it's risk on, risk off. But Dale, here is where I'm going to get your attention, because you look so intent. You look so attentive. You look so attentive, but I'm going to reward you with that attention because I'm going to make it easy. So are you ready? So you don't need to even put your body in front. You can step back. You can even lean back, and you can still get it.
Okay.
Just relax. Your health is more important.
All right. I'm relaxed.
Okay.
Hit me.
Okay. So basically, some people said, well, if this thing usually works with this, which one comes first? Which one leads the other? Right? If the spread does it, so I looked at it and I looked at it. And so what it is, so this is euro dollar. And what it is, now this is where I'm getting your attention. You see this thing here?
Yeah.
This is from the bottom of the spread to the bottom of euro dollar in October 2000, it was 16 months. Actually, it was not 16, it's 17. I later corrected it because what happened, and I'll tell you why, because euro dollar went to 107, went to 115, and then it went back towards 108. You remember? Or 107.
Retest,
actually.
yeah.
It retest, and then it went back up. So I redid my math. But this chart, and I will show you the live chart from Bloomberg. because I am honest with you and I'm very transparent. I don't BS anyone. This is from the March Expo in New York, and it was 16 months. But you know what? It actually, this is not 16, it's 17, and I'm going to prove it to you. But the idea works, and I'll show it to you when I go to Bloomberg and I take it back. What time is it, man? Okay, so basically 16 months later, after the bottom, this bottom, and 20 years later, you can't make this stuff up. You can't make this stuff up. The spread reached the bottom, and then only 16 months later, euro dollar reached the bottom. And if that doesn't get your attention, you might as well turn off the laptop, turn off your computer, switch off the power supply, change it to something else, and go do something else. And actually, you know what? Since we're at it, let me change the screen to Bloomberg, okay? Because I want to show you the live chart, because I care about people who says, oh, he's using old charts. And we don't want to do that. We don't want to misleading people. So what do I do? Where do I change the thing here?
So you stop sharing.
I go to
do a new share. New share.
I go to new share and I go here. Okay, let's go. So, and you don't need to take my word for it. So this is the chart, okay?
Yeah.
So when I take the, do you see the arrow here?
Yeah.
Do you see the arrow?
Got it.
I'm taking the arrow and it will tell you how long is this distance. What does it say? What does it say? The span. What is the duration of the span?
5.
No. Look at the blue,
that.
Look at the blue rectangle.
Yeah. Okay.
What does the span say?
17.
17 months, because it's a monthly chart. So 17 months between the time where we bottomed here in the spread, okay, to, because this distance measures from this low to the low of the price of euro dollar. 17 months.
Right.
Are you ready? I get it. Now, and I take you 2001, 2002. Some of you got married. Some of you got divorced. Some of you became mature. Some of you made money. Some of you lost money. Some of you started companies. Some of you started to pay to politics. Some of you lost money for the 5th time. And some of you gave up on FX for the 7th time. And then you go to 2013. And then you go to 2014. And then you go to 2016. And then you go to, and then everything becomes very, very, very political, and Trump and this and that, and people take to Facebook, and then everybody says, screw FX, I'm going.
Who gave you my diary?
Exactly. I know. And then people are going to go, oh, I'm going to get back to FX. It's time, because, you know, the game is all the VIX. And then you go in here, and guess what?
17.
What does the span say? What does the span say?
Sweet 17.
17. The distance from the low to the high. Like, you know, Baldwin said, have I got your attention? In Glengarry. Get your attention, acquire interest, and now hit them. Okay, now I'm going to hit you back. So I'm going to go back to the PowerPoint presentation, because we're just getting started and we're just getting warmed up. Okay, and okay, new share.
So when you knew you had 17 months, Ashraf, for the euro to bottom, what did you do during that time frame?
I'll tell you what I did.
Just waiting.
I'll tell you what I did. So basically, so this kind of works, and this tells you that even when euro dollar went back towards 107, 106, I said, because when it went to 115, you know, so I was in an Arabic TV in Dubai in January, and when euro dollar was what, 108, and I said to the presenter, I said, here's why euro dollar is going towards 120 this year. And I said, and they don't like technicals. So I said, here's the fundamentals. The fundamentals is that Lagarde is going to come in, inflation doesn't work, and what she's going to do, she's not going to do QE. She's not going to cut rates. She's going to do QE, but she's not going to cut rates because she realized that's bad for the banks. You're not going to cut rates, and the Germans will have to raise fiscal. Will have to go fiscal. And when they go fiscal, and when the Fed is going to come in, and they're going to have to cut interest rates, that is going to push it up. All the rest is detail. And that's that. If you want the fundamental, this is, and I called it ahead. I called it. So again, the Germans were criticized for not doing a lot of fiscal. They're saving the trade surplus. So what they did, when they did the fiscal, they saved the money on the ECB of not doing cutting rates. Meanwhile, Powell start cutting rates every other week and start injecting every other week. And then what happens? What happens? The interest rate differentials between the US and between Germany is shrank. And this baby that you're looking at, the spread, the 10-year yield, it shrank. Now, Euro-dollar, rare but effective breakout RSI models. Oh, so when the Euro-dollar start to push higher, and so it went to 115, it went to 107, and it start meandering. All of you who trade FX will know Euro-dollar was meandering between 109, 110, 110, 109, 110, 111, 110 for a while,
Ranging.
and it gave us false breakout many times. But this is the RSI breakout model that worked for me, and I said, this baby is going to town. It's going towards 115 and 117. It's not a pattern. It's not the leaves. It's not Lagarde. It's not the Germans doing much better handling of COVID, even though that works. It's not that Trump has no idea what's going on. It's not that Powell keeps on injecting and injecting and injecting, 20 times what he did in 2008. He did it in 1 week. That's all right, but it's not just that. This is the breakout. This is the oscillators that I mentioned to get your attention, but I wasn't lying, to get your attention in the oscillators breakout in the intro. This is how you apply it. So this is an old chart. RSI breakout, what am I talking about? Well, listen. So these are the most important patterns in the life of the euro for me that held on, that is called the breakout. Forget the moving averages. Look at this. 2002. This is when the bottom in the euro happened. This is an RSI, weekly RSI, and we broke out. And we broke out, and it was the beginning of something serious. It was the beginning of a bear market. Do you remember what I said about February 2002, Dale Pinkert, when I was boring you with the trade war and with the top in the US dollar in February 2002, and Bush going trade war on Brazil? Do you remember that? Well, if you RSI it, if you technicalize it, if you're going into retail FX and you want to convert nice talk on the papers to money, here's what happened. RSI breakout. Steve, I see Steve with his red shirt. Don't kick me out. I still have 20 more charts.
Tell you what.
I lived in New York. I know some swear words in Greece. Okay? It starts with an M and it ends with an A. Don't.
You should come to Face, and you have as much time as you want. But we are unfortunately on a very tight schedule.
So how much do we have?
We're over time already.
Okay, guys. Sorry, you have to give me a 3 minutes, okay? Sorry, this is important because it's to the benefit of your attendees, okay?
Okay, 3 minutes. We'll push everything back, but
how about 2 minutes?
2 minutes. Yeah, okay. Go.
Okay, go.
So basically, the RSI breakout happened here 2002. It happened in 2005, happened 2009, and it happened in 2020. Okay, don't bother trying to prove me wrong and saying the same thing happened in between 18. No, it didn't happen. And when this happened, that's it. Now you go back up. Yeah, how we traded it? Well, we have some trades. Everybody said Ashraf goes long euro dollar. Actually shorted euro dollar. There was a gravestone doji in September 1st, which is the top of euro dollar, and we sold it at 119, and we closed at 170. Never mind. Then you have the gold silver ratio. This is what I want to talk about. Putting it to good use. You know that basically when the gold to silver ratio goes up, metals go down. You know that. Okay. So now I'm going extra fast because we were chit-chatting and everything. And if you get it, you get it. If you don't get it, get the recorded version. This is yellow, but here is how you technicalize it. So basically what I said, and I basically did my math here. You go down 52, and I predicted that this is going to go up 52 from 83 to 135, and that's where we're going to top. So if gold silver is going to top, okay, that means that the bottom in silver versus the dollar is going to happen, and gold is going to happen. And exactly that's what happened. And you can check it. And what happened afterward? Anticipating and confirming cyclical breakout. When your euro dollar start to push higher, and your gold start to push higher, and you made money, and you bought euro dollar at 112, and you close at 113, and you say, oh, that's it, it's going to stop at 115. It's not going. Well, here is the thing that is going to give you confidence, because when silver break out and metals break out, that's your ticket to going all in selling dollar. And this. How we went long silver 10 days before the biggest breakout in 10 years. Basically, this was May 8th. We had a nice pattern here. Everybody knows it. Yeah, a triangle. But this is what people haven't done and haven't seen. This is all great, right?
Yeah.
But this
great
is
call.
and people who are going to cut me off, don't cut me off because this is important. Silver's 6-month habit of breaking above its 55 moving average. When it breaks above it, it takes off, and it happens every 6 months. You don't need to believe me, you don't need to take my word for it. Just look at the chart. And it happened in May, okay? It happened in May, it happened in December, it happened in July 19, December 18, June 18, December 17. You don't need to prove me wrong or to prove me right. You need to do it later because there's a person speaking after me. But this gave us the confidence. And this is just not just a looking back kind of thing. This actually what we use for our, actually the WhatsApp group. And we told them, this is why we're going, and this is why we're going by silver, okay? 10 days later, again, the moving average, this happened, okay? Everybody lost money in a false break, and you got the RSI breakout. And this stuff happens, okay? How far is far enough in the move? Well, guess what? When gold to silver started to fall and metals started to go up, everybody said it's overdone because we've got geniuses in Twitter. Everybody said it's overdone, but it's not. Because when you break the trend line support, which I called it here on July 20th, okay? Gold to silver ratio, when it breaks, that's when you say, baby. Metals went from 17 to, hold on.
Halftime break, and we continue in phase.
I'm going to skip the golden triangles. I'm going to skip the golden triangles.
We really have to wrap it up now. I'm really sorry, but we have to.
And this is basically where you get more information from me. And this is the stuff. And this is what people said about the WhatsApp group. And I wanted to help people to try to get them into it. And this is Ashraf Laidi on Twitter. And this is Ashraf Laidi on anywhere you want it. But basically, I wanted to get into the live chart to show you where we are right now. And to show you what are we going to do with gold. Are we going to do with silver? And whether the gold-silver ratio is going to break out and whether the dollar, euro-dollar, is going to go towards 113 or it's going to bounce to 115. I wanted to tell you all of these things, but you have to respect time. Who respects time on a Sunday?
We will
I'll tell you what, Ashraf, on face, we don't have a time limit. So Dale, when is your first opening for Ashraf?
I'll find one soon.
Yeah.
Okay, Ashraf, you'll come on face and speak until you have nothing else left to say. Okay, that's a promise.
Ashraf,
thank you very much.
I want to thank you, Ashraf, for coming here today on a day off to recharge. And I love your work, and I really love your passion for what you do.
Feel free to send me a summary of the questions that people asked, and,
sure thing.
I will tackle them. Yeah. Do that.
Absolutely.
If you have time.
Nice having
you. Thank you, Ashraf. Thank you very much.
Thank you, my trading warrior brother. Great to talk to you.
Bye-bye,
Thank you, Ashraf. Okay, well, as you can see, Ashraf really is passionate about what he does. He's, you know,
he definitely is
very high energy, and I respect Ashraf. Just want to let everyone know that. And
hey,
so
Tyler.
Tyler's here.
Good morning and good afternoon.
Hey, Tyler. Tyler, how are you? You're ready to talk about the CMT?
I'm ready to talk about whatever you guys want to talk about.
All right. Well,
but I have to say,
European soccer. Then
this entire conference has been awesome.
Thank you for sponsoring.
Sorry, go ahead, Dale.
Being one of our sponsors, Tyler. We appreciate it.
Of course.
And so why don't you tell us about the CMT program, which I'm seeing a big trend towards people that didn't have this designation certification before. I'm seeing more and more of it. Are you getting growth and a lot more interest?
We're in a massive bullish breakout, Dale.
Okay. It's confirming, momentum's confirming price?
Momentum is confirming, that's right. We're we haven't gone parabolic yet, but things are moving in the right direction.
Yeah, I'd rather have it be a healthy trend, so that's good, man. All right.
That's right. No, I've been following Ashraf's work for a long time, and was very happy to give up a few minutes about the CMT Association. So I'll keep this really quick. I think you guys have just an incredible lineup of speakers. The education is outstanding, and that's what the CMT Association does, is help folks throughout the industry to understand the value and utility technical analysis. So we do a lot of different things. We're a global nonprofit. We've been around about 50 years. But today I'm just going to talk about the CMT program, which is a certification for financial industry professionals. It's 3 exams. We offer those twice a year. You do have to take each level in sequence. But really the CMT designation is there to deliver 2 different outcomes. We want to improve investment performance, and we want to help open up career opportunities for folks. And that exam, that program is recognized around the world. We've got members in 137 countries. I spend a lot of my time talking to investment firms and banks about the value of the CMT designation. And then, of course, we work with regulators all around the world. So we're recognized by FINRA in the US. We're working on projects with SEBI in India right now, IROC in Canada, you name it. So for those of you who've already been considering it, I know we've got hundreds of folks on the line from all around the world. Perhaps some of you are already registered. I just wanted to mention the next exam dates are December 1st through the 15th. So you've got about 9 weeks to prepare for that level 1 exam. And what we're going to talk about today is a little bit about why that's valuable, a little bit about the basics that we think will improve investment decision making. And it rang true to me when Ashraf was talking about, when do you know to stick to your guns? When do you know to abandon your trade? And that's really the crux of what the CMT program is all about, is developing a rigorous, systematic process for how you evaluate risk and reward. So a lot of people have maybe heard of the CMT designation. As you mentioned, Dale, it's gaining in popularity. You're seeing it around the world. But why do people pursue what is really a very academically rigorous program of study, very difficult exams, and they're going to dedicate at least a year of their life to earning this designation? Well, what it comes down to is the differentiated value that comes from being a certified, a chartered market technician, having a certification that tells the world what you know about technical analysis. So that graphic that you're seeing on the right-hand side of the screen, our marketing team just took some creative impulse around survey data. So we asked CMT charter holders a year after they earned their designation, what's that done for you career-wise? And you'll see about 40% were promoted, a little over 50 had new positions in the industry. But the one I want to harp on for a second is that almost 60% of new CMT charter holders had gained more responsibility within their firms in the year after earning the charter. And what that means is that for any money manager out there, you might be trading your own account, but you might be thinking about bringing on some clients, expanding your AUM. That more responsibility is an expanded AUM. The folks who earned the CMT designation had the trust of their clients and their firms to manage more money because they had a repeatable, systematic process for how they were going to approach markets. And the CMT program isn't a trading scheme. We're not prescribing any one way to look at the markets. And in fact, we feel like there are infinite ways to separate noise from information to find an edge in the markets. The program is really just about you developing your own set of tools and using all of the elements of the CMT program. So let's dive into that real quick. We're talking about technical analysis, but everybody has their own definition of what that means, right? For us, it's the study of price action and market statistics, for example, volume, that help you infer price trends and manage risk. But there are a lot of other really great definitions out there. If you go to the Bible of technical analysis, Edwards and McGee said that it's the study of the action of the market itself. It's a pretty solid definition. We've heard at conferences time and time again, people talk about supply and demand. It's just about understanding supply and demand. Where's there pressure from sellers? Where is there momentum from buyers? Technical analysis might be about the supply and demand for shares or contracts. And then this one comes from a good friend, Perry Kaufman, and a lot of his work is in our curriculum. And he talks about the systematic evaluation of price and volume for the purpose of price forecasting. And so for everybody out there who says, yeah, technical analysis, I'm a quant, I'm an algorithmic trader. I've moved beyond technical analysis. I would answer you this, and I would say that algorithmic trading, having a machine that actually delivers the trades for you, that makes perfect sense, right? An algorithm is, in essence, just a program for making decisions in an orderly way. But technical analysis is where you're going to find signal and how you're going to separate noise from signal in this world of data that's out there. So let's talk real quickly. The CMT program at its very core, the level one where you start, is understanding data organization, data visualization. What are we doing with all this information that is pouring out of the markets at us? So on screen, you're looking at a new chart. We've got members all over the world who are developing really cool ways of understanding what's happening in the market. And that's just the G10 currencies. We're looking at a heat map, right? So technical analysis is not just price charts, but you could look at composite information across whole sectors, across whole asset classes. And this is just looking at the currencies, and you can tell immediately that in the last week, we've had a major shift. That color coding is actually blending the most common trend and momentum indicators that exist. So you're looking at securities, individual currencies that have gone from really bearish environment, suddenly turning bullish. And we're seeing a big rotation within that. Let's move on. We've got the concept of relative strength. So instead of just looking at that heat map, this chart's a few weeks old, but we're looking at the sectors of the S&P 500. And relative rotation graphs, as they are called, are about 10 years old. But it's a concept of looking at multiple securities against a benchmark, in this case, the sector ETFs against the SPY. And you're looking for those that are moving from leadership to laggardship, or from laggardship to leadership, to understand where your next opportunities are going to come from. And this is just a new way of visualizing data. All right. We talk about divergence, how important. Ashraf mentioned this a bunch of times, and Axel, who's going to come on right after me, is going to talk about divergence in a million different ways. This is one way to look at it. Again, I'm looking at a go-no-go chart where you've got a really bearish looking trend for US dollar. You're seeing a divergence in the oscillator, and that's a composite of RSI and other momentum indicators. And there, indeed, we found the breakout just at the end of last week. That divergence is a leading indicator of what might come, where we want to be paying attention. And as Ashraf was questioning, when do we know when we're wrong, right? When we don't get confirmation, when we're deep into a trend, when we've expanded our position size, we want to look for signs of weakness early on. We don't want to wait for price to tell us that we were wrong and give back all of those profits. So these are some of the core components of the CMT program. And hopefully for those who are interested in the markets, who are coming here on a Sunday to learn, you'll find some value in the CMT program as well. So real quick, the 2020 CMT curriculum, it's published by Wiley. You have a consolidated textbook at each level of the program, and that's really just going to provide a very efficient study. I get asked all the time from retail traders around the world who say, can you provide just a basic introduction to technical analysis? I'm just getting started. And honestly, without bias, I want to tell you that the level one curriculum is a very broad, very basic understanding of TA. And for me, I had to learn all of this on the job. 10 years ago, after finishing my MBA, all I knew was that technical analysis was voodoo, and corporate finance, you needed to focus on the fundamentals. And it's been a real eye-opening experience for me, and hopefully it will be for you as well. Our good friends at Wiley wanted you to know that you can take 30% off the textbooks there. That code is CMTTW30, and that'll save you 30% on your textbooks. And my last chart, I promise, Dale, we're going to get to Axel in just a moment. For those of you who are considering the CMT program, who want to invest in your own professional development, who are aspiring to join the financial services industry, or maybe you already are, maybe you're a veteran 20 years into the game, I really encourage you to think about focusing on your process and developing these tools. So for those of you who are ready to register for the CMT program, at level one, you can save $200 on your registration. That's LVLILR is the code to get in there. And I'll send these around to the team at Forex Analytics, Trader Summit as well. And that concludes everything that I wanted to share today, except to invite you all to join us next week. I know the Forex Analytics team is going to be a part of our virtual summit. It's being centered from our office in Mumbai, but it's open to a cast of speakers and attendees as well. So how did I do, Dale? Did I get us in?
You know what? You are a great ambassador, and I love your demeanor. You're a
He
great
totally-
ambassador for CMT. And here's what I say, Tyler.
What's that?
Invest in education and pay for it, or pay the market.
That's right.
One
It's
or
a
the
lot
other is going to
of
happen. So
learn from other mistakes, right?
yeah, I mean, invest in yourself.
There you go.
And
Very
learn.
And learn. Well, Stylianos and Steve and Dale, Joe, the whole team, I really appreciate you guys having us on board.
Nice having you on,
Thank you,
Tyler.
Tyler.
Yeah, really looking forward to the next one and having you guys be a part of our summit coming out of India in a couple of weeks.
Perfect.
Thank you, brother.
That's perfect. Have a wonderful Sunday.
Yes, thank you as well, guys. I'll talk to you soon.
Bye-bye.
Thank you, Tyler.
Bye.
Tyler Wood,
Bye-bye.
a great ambassador for the CMT. And I love to meet new traders and new people that I haven't talked to before. Now I have the pleasure of meeting Axel Kabar. Axel, very nice to meet you. You're muted. I can see if you unmute your mic.
And
There you go.
There you go.
Nice
Hi
to
there,
meet you,
how are you?
Axel.
Hi,
I'm
everyone.
okay. Very nice to meet you, Axel. I was looking forward to talking to you. And for people that may not be familiar with you, you're the founder of Tech Charts LLC. What a surprise, you're a technician, and research and trading firm. You're an educator, you're a mentor, and you teach classical charting principles. Let me ask you this. Do you remember a book called Technical Analysis of Stock Trends by Edwards and McGee?
Of
Or
course.
are you too young?
No, of course I remember, and I went and I bought the 5th edition,
Okay.
secondhand, and I got a really good price from Amazon. So I have it
Okay.
handy on my desk always.
That was my Bible in the 70s. I took it at my first course in technical analysis. That was the book the instructor told us to buy, and it's timeless.
Yeah.
And yeah, I was wondering if that was maybe a foundation for your work. So
Definitely. Richard Schabackers and Edwards and McGee, which I will be discussing in the slides in a while.
yeah.
And that book definitely is, both of them are definitely a must read.
All right, before you get into your presentation, I'm always interested in how people ended up in the industry, what their life was pre looking at charts and trading. What was your story and your early journey like?
Yeah, so my involvement is 1999 when I started economics degree.
Okay.
So obviously the markets are booming. Tech bubble and so on, so somehow that reached to us as well, and I asked one day, so what are those stocks, how do we buy those things? And that's how I got involved. 1999 2000, which was the peak.
Right.
And since then the crash happened. And during the crash, I was looking for an internship while I was working, while I was studying economics. So economics 101, rational expectations, efficient market hypothesis. And meanwhile, I'm looking at charts and I'm seeing irrationality and so on. So I said, this can't be the real deal. So I should really focus on something else that makes more sense. So then I started learning about technical analysis, and I had the chance.
Who were your influences in technical analysis? You have any?
Yeah, basically I had a mentor in Turkey, and I worked with him during my internship. He was a very kind gentleman, and internships are not that easy, but it was more like a mentorship for me. He basically taught me everything from scratch, from Elliott wave to indicators, and I ordered books from Amazon, and basically a lot of self-study happened. And when I finished, it was a 1.5 year long internship. When I was going to school, I was skipping some of the classes in the afternoon and going immediately to start the second half of the trading day. And it was a brokerage firm, so it was like the kitchen. You see every sentiment.
Right.
It was the head office also. So we were receiving a lot of calls from different dealers, brokers, asking about opinions on different stocks.
Wow.
And then, yeah, so that's where I learned. And then when I went to Canada for my master's degree, again in economics, because there was no way for me to go into finance, because at least economics made more sense for me in terms of the behavioral side of things. So when I went to Canada, that's where I got my CMT degree. CMT exams, I passed them. The first two was basically after reading all the books over the years. I was able to sit down and pass those two levels. I don't know how difficult they are today, but I had to do a lot of reading. So basically, that's how I got involved in technical analysis, economics, and then my real test of experience was in the Middle East when I joined National Bank of Abu Dhabi, first as a technical analyst, and then started managing their trading fund, which was the biggest in the region, the largest fund in the region. Then I moved to the semi-sovereign fund, Abu Dhabi Investment Company, and then to Emirates Investment Company, EIIC. So basically, the test of my knowledge during that 10 years of UAE experience was put into the markets.
You really had a great journey. You know, can you imagine what people go through that try to get to point B with just the internet and trying to discern between what is real and what is fraud and everything else? You had a mentor, and that's a common theme I hear from professionals, is that they all had one key individual that really gave them a hand. And what's that expression? When the student is ready, the teacher appears. And sounds like you were fortunate in your journey, and then to end up managing a fund in Abu Dhabi. You have some guardian angels looking after your career, Axel.
Yeah. So the key here is for new beginners is that keep pushing for it, because there were several times when rejections happened and interviews went bad, and I felt like the industry was pushing me away, and I kept on trying and trying to find the best way to apply my knowledge. So this will happen. Even today's market is more difficult with the job market, obviously, and the difficult condition. But keep trying and
great advice.
Learning. Yeah. And the time will come. I'm sure that opportunity, the door will open up, and that opportunity.
It's kind of like trading, right? Trading, there's no, people say they have a secret to trading, and the secret is there is no secret. It's hard work and perseverance and living through adversity. And if that scares you, find something else to do.
Very true. Yeah.
Okay, so what do you have? You have anything prepared for us, or?
Yeah. So I have a presentation that I'll go through. Okay. So the aim of today's presentation is basically to highlight important concepts in classical charting and apply those on long-term equity and FX charts.
Okay, so great.
Let me start with sharing my screen, and then we can go through those slides. Share screen.
Green box. Drop down. Got it.
Okay, this is visible, right?
Yep, we have it. Tech charts, demystifying the world of classical charting.
Yeah. Okay, so let me move this video also to the top, or maybe even hide it. Okay. Okay, so as you mentioned, classical charting principles, the Bibles, 10 Technical Analysis and Stock Market Profits. I really enjoyed this book as well. Richard Schabacher's, and the other book is Technical Analysis of Stock Trends, Edwards and McGee. Now,
the first one, I think, Axel, the first one I think was written when, in 1932? The one by Schabacher, and then they modernized it, Edwards and McGee, in what, like in the 40s or 50s?
Yeah.
Okay, but the root of Edwards and McGee is Schabacher's work.
Yes, yes, yes.
Okay, great.
So technical analysis and use of charts are usually regarded as short-term timing tools. I disagree with this point of view. I think the use of charting with a slightly longer term perspective is more helpful for the professionals who are managing funds and portfolios with the help of fundamental analysis. Over this period of 10 years, when I was working with funds, I came across a lot of fundamental guys who are managing a large amount of money with a fundamental approach, and their always view was that technical analysis for short-term timing, where do we enter and where do we exit? But if you try to actually show the fundamental guys the long-term perspective of charts, where the asset allocation can happen, where the shifts are happening, it makes more sense. So when the trader or the idea generation happens, like, okay, we bought it, now we have to exit here, it's a shocker for the fundamental guy, because they already have a view on that market. So why do we exit? Why do we enter? So it's always better to provide the bigger picture to make more sense and to catch the bigger trends also. So that's why I think if we focus on the slightly longer term perspective, we get more attention and we are able to explain the basic principles of technical analysis and classical charting. As we started, it is important to note that classical chart patterns do not frequently form on price charts. Most of the time, price will not reveal a tradable and recognizable chart pattern. That is fine. Thanks to the hundreds and thousands of instruments available for trading, we can always move to a new chart for a well-defined chart pattern. So on this one, for example, you're seeing two charts. The chart on the left-hand side is the sugar futures. The chart on the right-hand side is a stock from New York Stock Exchange. One is John Wiley, the other one sugar futures. Do you see the similarities of these chart patterns? A year-long symmetrical triangle and a year-long symmetrical triangle on the left-hand side. So those chart patterns keep on forming on different instruments. Our job as the technician or the trader or the investor is to be able to identify those chart patterns as we step back and look at the price charts. Now, the more we force ourselves to identify chart patterns or patterns on price charts, the higher the failure rate. So those type of chart patterns usually pop up when you open the chart, when you look at the price chart. So that's how it's supposed to be. If we force our analysis on a specific instruments, at that point we're making probably a mistake. We should let the chart speak to us, not we wanting to get some information from the chart. Another thing I want to discuss is that trend periods are followed by consolidations, and consolidations are followed by trend periods. Each consolidation will result in some sort of low volatility condition. It is that low volatility setup that usually gives way to a high volatility and strong trend period. So we want to capture those strong trend periods following those consolidations. So the idea actually here, when we're looking at classical chart patterns or some sort of consolidation, is basically to understand where the trend finishes and where the consolidation starts. Now, these are the 8 classical chart patterns that I'm focusing on. There are several others, but why am I focusing on these specific ones? Because they are mostly horizontal chart patterns with horizontal boundaries. it is very easy to, or common for a beginner technician, chartist to draw diagonal boundaries, connecting two lows and extending it to right, and then this trend line breaks down. We adjust that trend line again, and another trend line forms, and so on. So with horizontal boundaries, this doesn't happen. With horizontal boundaries, it is a clear line that we know that supply and demand exists. So ascending triangle, for example, the top one, is a horizontal chart pattern with the upper boundary clearly horizontal. The lower boundary gives its bullish bias because at every correction, at every pullback, buyers push the price higher. They are more impatient. They are not waiting for the previous low. They are coming and buying the stock or the instrument at a higher level. And then this at a higher level, eventually breakout takes place. The chart and the illustration next to it, cup with handle. Again, it's a horizontal chart pattern. This time, it's one less swing than the ascending triangle. Rectangle is one of my favorite because it's easy to identify on the price charts. So it's a sideways consolidation with several tests of chart pattern boundary. Descending triangle is the bearish version of the ascending triangle. Its bearish bias comes from the downward sloping trend line. So we have the sellers this time being impatient and selling at a lower high after every rebound. Head and shoulder top, all these, but goldies. Both head and shoulder top and head and shoulder bottom are the widely known chart patterns and the most talked about. So head and shoulder top is a bearish chart pattern. It's a reversal. Again, with those type of reversal chart patterns, head and shoulder top and head and shoulder bottom, I focus on the ones only with horizontal boundaries. So there can be a neckline that is sloping upwards or as a neckline that is sloping downwards, but I usually focus on the ones that have clear horizontal neckline. Then
can I interrupt you on that head and oh, you're getting to it right now. So you have come to believe, and I was always taught that it's a reversal formation. You're a believer that it can also be a continuation formation.
Yes.
And this is more modern, more of a modern interpretation, right?
There is actually in Edwards and McGee, this is discussed, head and shoulder continuation. Now,
I'm going to have to go back to it. Huh.
Yeah, the idea actually here is important. Then what name we are actually giving to those type of chart patterns. The idea here is that, so you have the first swing here, and then volatility picks up, okay, with the head. And then we have the volatility shrinking here, which forms a higher low. So that higher low is actually the preparation for a breakout higher.
I see. Okay,
so that's what we actually care. Now with cup with handle, volatility picks up during cup formation, and the handle is actually a higher low where the volatility is shrinking. And from that low volatility condition, you're getting the expansion in volatility and the breakout.
Okay, so vol is your cue about the validity of the formation.
Exactly. So you want to see several tests of the boundary, which I will be discussing in the couple of slides and following slides, and also the low volatility condition giving rise to a nice trend period. Now the other one, the only diagonal chart pattern that I focus on is the symmetrical triangle. This is a neutral chart pattern because both the buyers and sellers are pushing the price to a direction where there is indecision until there is a breakout. So symmetrical triangle can act as a bottom reversal, can act as a bullish continuation or bearish continuation chart pattern. So this is a neutral chart pattern, but again, we will discuss with different concepts.
Do you ever see breakdowns of going against a trend? You get a symmetrical triangle. Is it always a continuation formation?
No, a symmetrical triangle can act as a reversal chart pattern as well.
Okay.
Yeah.
Thank you.
So here breakouts from chart patterns with horizontal boundaries are reliable. Why? I like to focus on breakouts from horizontal boundaries. Now, the chart on the left-hand side, Dale, by the way, here is a nice head and shoulder continuation example. It's an equity. So you can see the horizontal boundary here, very clear.
Yes.
The breakout takes place after several tests of the chart pattern boundary. We see a nice consolidation and the continuation of the uptrend. So this is a 20-month-long head and shoulder continuation. The chart on the right-hand side is a year-long symmetrical triangle in Volkswagen that is acting as a bottom reversal. Now, prior trend is clearly down, and then we start seeing this tight coil consolidation. Now, the problem with these type of diagonal chart patterns, chart patterns with diagonal boundaries, is that once there is a breakout, it's like the horses at the starting box. They have so much energy that when the door opens, you want them to run fast. But all of a sudden, you're putting a hurdle, the minor highs, where the resistances are. So before the trend develops, you're giving them hurdles. Whereas with the horizontal boundary breakouts, you're in most of the time you're in uncharted territory. You're clearing all the minor highs prior to that. So it's path of least resistance, I'm calling it. In this case,
and in your example on the left, you never even had a test of the breakout.
Exactly.
If you know, a lot of people wait for retests of breakouts. I've always said the best breakouts are the ones that don't retest, or maybe just once. But if you get multiple tests of a breakout, to be skeptical. Do you agree with that?
I agree with that. In fact, it was such a strong breakout to all-time highs that the consolidation only took place well above the chart pattern boundary here.
Right.
So basically the defense took place at a much higher level. Obviously, we see several breakouts that come and test the chart pattern boundary. These are hard retests, depends on the market condition and so on. But this was a breakout to all-time highs. So in the chart pattern on the right-hand side, the symmetrical triangle, you have the hurdle, the minor high. So that's a problem. That doesn't mean that the chart pattern will not succeed, but horizontals are more reliable. The next one is breakout to all-time highs. Chart set up above long-term averages. Now, I'm using the 200-day moving average on my charts as a trend filter. I want to see breakouts taking place above the long-term average, bullish ones, and the bearish ones below the moving average. So if you see, for example, a chart pattern like this, by the way, this is another stock, unlike the chart on the right-hand side we've just discussed a while ago, another head and shoulder continuation. This time it's a 2-year-long head and shoulder continuation. You see this left shoulder head, the volatility increases, and then volatility starts shrinking. You see each low forming at a higher level. At this point, we are excited because the breakout is going to take place to all-time highs. And guess what? The breakout is going to take place above the long-term average. So we have 1, breakout to all-time highs possibility. 2, breakout is taking place above a long-term average. 3, we are breaking out from a horizontal chart pattern. So when these couple of things are lining up, you have a higher conviction in the trade idea. Several tests of chart pattern boundary. The more you test a chart pattern boundary, the more energy is built. It's like the earthquake. 10 years you haven't seen a breakout, 10 years you haven't seen an earthquake in an earthquake zone, chances are high the next one is going to be a bigger earthquake.
I'm in California, Axel, so, you know, anyway.
Yeah.
We haven't had one in a while. All right, go ahead.
Sorry about that.
Well, you have them in Turkey too.
I've lived one in Turkey.
All right, yeah, go ahead.
1999.
Shake, rattle, and roll, buddy.
So you see several tests of chart pattern boundary. That's a good sign. The more tests, the better it is. So the breakouts that take place after several tests of chart pattern boundary are usually producing strong trends. After a 3-year-long consolidation, several tests, here the preparation and the breakout. Again, the chart on the right-hand side is a 5-year-long sideways consolidation. 1, 2, 3, 4, 5 tests, and the breakout takes place. Chart patterns in the context of broader price action. Now, what we're saying here is that when you're seeing a chart pattern on a price chart, look where it is forming. Is it after an advance? Is it after a decline? So we saw this rectangle here on the chart on the left-hand side, and we start saying that, okay, fine. So we are in a downtrend, and this can actually act like a continuation, a bearish continuation. But the price is moving higher. Does that mean that this rectangle will not succeed? No, it will succeed, but remind yourself that this is trying to reverse an existing downtrend, so it can be more choppy, as in this example. So even though there is a breakout from a rectangle, we chopped around the chart pattern boundary.
Well, we actually negated the breakout there. How do you handle that?
Yeah, if you're using wider stops, you will be okay. If you're using tighter stops, you will get stopped out, and then there is the second try.
You have to recommit.
Yeah.
You have to know when to recommit if you're taken out.
Exactly. So the second time the breakout renews its strength is the chance that you can give it another try on the chart pattern. The chart on the right-hand side has already momentum. So the first buying happened in this stock. And then we entered into a consolidation, the rectangle. Now we're trying to break out, so you have higher conviction that this can run this time, because the first accumulation phase is over. The rectangle finished the consolidation. Now it can be a stronger trend, which actually took place following that breakout compared to the previous one. So chart patterns in the context of broader price action. This is what I'm calling it. Now, this is an interesting concept, launching pattern. Identification of a launching pattern. Now, of course, my late mentor, Peter Brandt, his books are a gem, and I have basically memorized both of his books. And this is his concept, the launching pattern. What does this mean?
What do you mean late?
Since 2014, I get the chance to meet Peter Brandt, and I've attended one of their traders get-together.
Okay.
So our friendship.
He's still around, though. He's still around. He's still around.
Yes,
right?
of course.
Okay.
My first mentor in Turkey, and then my second mentor, Peter Brandt, talks about the launching pattern.
Okay.
So what does this mean? And I've seen several examples of those on price charts. So what do we have here is a cup with handle, and the handle part forms as a separate chart pattern. So this is a 6-month-long symmetrical triangle acting as a launching pattern, completing at the same time. So you have two chart patterns completing at the same time, cup with handle and the symmetrical triangle. Now let's look at this one, 15-month-long cup with handle. The handle part is a 4-month-long rectangle acting as a launching pattern.
Can I make one point here?
Sure.
Okay, so on this pattern you have to the left, that's a breakaway gap, right, Axel?
This one, yes.
Yeah, okay, so a lot of FX traders, they have this thing in their head, all gaps are filled. And after you'd have a gap higher opening, a lot of people would try and short it looking for the gap fill. I tell them there are different types of gaps. There are area gaps, there are runaway gaps, and breakaway gaps. And if you're waiting for that gap to be filled, who knows if it ever was, and you're broke if it does after that anyway. So all gaps are not filled, are
Exactly.
they? Okay.
Exactly.
Thank
you.
So
the chart on the right-hand side, this time, the 5-year-long sideways consolidation, the last part was a 16-month-long rectangle that acted as a launching pattern. So when we see those two chart patterns forming around the same area, that's a high conviction setup. Long-term chart patterns will launch strong uptrends. The chart on the left-hand side, dollar Turkish lira, again, head and shoulder continuation, prior trend since 1990s coming to this point, left shoulder, head, right shoulder, horizontal boundary, several tests, the breakout, a minor consolidation here. When I say minor, it was several months long, but a very tight range. As you can see, this is very low volatility setup. It was just the right time to basically initiate long positions, and obviously this followed.
Still hasn't looked back.
Still hasn't looked back. The chart on the right hand side, again, the longer the consolidation, the stronger the trend that follows. A decisive breakout is usually more reliable. This is the price chart of Logitech. So we see an ascending triangle here, the monthly scale. When we see a strong breakout, it's usually difficult for traders to jump on board and they say usually it's too late, or let me wait for a pullback. But usually those strong breakouts produce the strong trends, because that shows big funds buying into the stock. So you better position yourself on a strong breakout than a weak breakout. Strong breakouts, again, a decisive move, usually is followed by a strong trend. Breakout above more than one technical resistance. So we have a year-long symmetrical triangle here forming as a reversal, and we have a trend line at the same level. If you're breaking above more than one technical level, that's better than breaking above one technical level. So that's another concept.
It's like confluence.
Yes. Here we have, again, another example, the Oracle price chart. This was a downtrend. Breakout takes place above the downtrend, and then the rectangle breakout takes place. So higher conviction. You have two technical levels already completed, already breached on the upside, so you have higher conviction. Breakout above more than one technical resistance. Again, another example here, the symmetrical triangle and the downtrend completing at the same time on the upside. This was Baidu price chart. Now let's move to some more exciting current examples. Again, we're going to apply what we have seen, the classical chart patterns, on the price charts of long-term FX charts. Now, widely discussed and talked about US dollar index. Symmetrical triangle, this is what I see it as. Prior to that, a rectangle. The breakout takes place, and this is not that clear, but possibly a head and shoulder continuation that completed on the upside. Now, when we look at the price chart on the right-hand side here, this symmetrical triangle completed with a rectangle, launching pattern, and symmetrical triangle breakout at the same time, followed by a consolidation. Now, I'm seeing similarities between what is forming here and what has formed here.
It's like a fractal.
Like a fractal, exactly. So the left shoulder, it's taking a little bit longer. It's a larger scale, but this low of the shoulder, and then violating that previous high here, violation of the previous high, and then selling off to form the head here, forming the head, and then for the right shoulder, a rally to form the completing the head, a rally, and then the right shoulder. Now it's going to be interesting because on the monthly scale, if this month finishes strong, we have a bullish engulfing candlestick that can signal a nice reversal on the monthly scale.
Would you buy it there, or do you have to wait for the breakout of the head and shoulders continuation formation?
Well, usually FX is a more strategic position for me. And so it's more than a trading position. I allocate funds to basically dollar or euro because of my where I'm living. And I can say that I've been, maybe my views are biased because I'm fully long right now, US dollar. Now, there are different ways of trading the head and shoulder. You can buy it at the formation of the shoulder, given that now you have the bullish engulfing candlestick supporting, because the low of the shoulder can extend to 90, we don't know. But this bullish engulfing can add a little bit more perspective to the possibility of a rebound. So that being said, with a stop below the bullish engulfing, initial position, and then the breakout above the second layer. If there is a pullback, third layer. So there are different ways of scaling in with classical chart patterns.
Okay, thank you.
The next chart is dollar, Singapore dollar, US dollar versus Singapore dollar. Now, what do we have here? Ascending triangle. At the end of a trend, ascending triangle acted as a reversal. Do you see the horizontal boundary?
Yes.
A clear one. And the lower boundary is upward sloping, so it shows
Yes.
that the buyers are becoming more impatient, and this low is not even reaching the lower boundary. So here, this breakout, the decisive breakout, is the signal. Now let's move here, the symmetrical triangle. It's a clear consolidation that broke out on the upside. So this was a reversal signal. Now what we have here is a better defined head and shoulder continuation than the dollar index, with the horizontal boundary being at 144. If we see a rally towards 144, chances are high that 2021, 2022 would be an uptrend for the US dollar against the Singapore dollar.
Great luck.
Now this chart, as I said, classical chart patterns do not appear always on price chart, so we shouldn't force our analysis on the price chart, but rather, if we see a classical chart pattern, we take that opportunity as a trade idea or an investment idea. Here, for studying purposes, again, symmetrical triangle acted as a bottom reversal in 2001, 2002 after a clear downtrend. The breakout take place at the same time when we cleared the trend channel. So as you can see, there are times when you see when you see chart patterns, and there are times that there is no recognizable chart pattern on the price charts. It's more like random. So during those times, leave that chart alone. Focus on the other opportunities you have in your opportunity set. Now this is going to be, I think, the most important chart. Why am I saying that? This is dollar Japanese yen. Why am I saying this? Just because of the historical low volatility condition that we're experiencing on this price chart. This is the, again, monthly scale price, and the way the dollar yen cross rate has been consolidating in such a tight range tells me that a strong breakout is due. And if this takes place on the upside, I'm not giving direction yet because symmetrical triangle is a neutral chart pattern, but I'm also seeing the possibility of a head and shoulder bottom here, with the right shoulder being as a symmetrical triangle, launching pattern. So if this thing breaks out on the upside, quickly we will find ourselves at 125. But the actual price action, I think, will start after we complete that head and shoulder bottom, if it takes place. So step by step, we will see. But what I'm watching are those two tight chart pattern boundaries for a decisive breakout. Now you can see that this bottom reversal also formed as a small head and shoulder. So shoulder, head, shoulder, that acted as a reversal inside the big chart pattern.
Yeah, when you look at that, it's been doing nothing for 7 years except developing the whatever it's developing, the symmetrical triangle.
Yes. So usually from those low volatility conditions, strong breakouts, strong trend periods emerge.
Okay.
The next chart is euro dollar. What do we have here? First of all, we have a clear downward trend channel that has been tested on the upside several times, and the last time we touched 120, 119 area was actually the upper boundary of that trend channel. Now I had doubts that this trend channel might be valid or not, but given that we have reversed from there, now I'm a little bit more convinced that if we break above 120, it's a change of plans basically. Euro gains strength, dollar loses against major currencies. But if we go and test the lower boundary, the widely discussed parity might start becoming a topic again for the euro dollar.
Okay, we have to wrap up in a minute or two, Axel.
Sure.
Axel, yeah, unfortunately, time is pressing. We need to wrap it up.
Sure. We have few more slides and I will wrap up.
Go ahead. Go ahead.
So the next chart is dollar, Mexican peso. Now we move to the emerging market currencies, and you can see that dollar has been gaining against the emerging market currencies as well. A clear symmetrical triangle followed by another symmetrical triangle breakout, pulled back. Now probably we have a continuation. The next chart is the Brazilian real. So here we had a huge double bottom. Inside the double bottom, this was a clear head and shoulder bottom. Rectangle here acted as a launching pattern. We reached to 2002 highs. We formed this nice cup with handle and broke out to all-time highs. Now you can see that dollar is also gaining against Brazilian real. Emerging market currencies are weak. This one is South African rand. You can see this cup with handle here, how the low volatility conditions set up for this long-term breakout, the symmetrical triangle, and the cup with handle, the recent one, which broke out with a decisive candle, pulled back, and now probably we're due for a rebound. The next chart is the Russian ruble. Now the Russian ruble hasn't broken out yet, but it has formed a several-year-long ascending triangle with this clear horizontal boundary at 80.5. So the breakout can easily take us to 110 and all-time highs. So this is a very clear chart. You can see that the buyers have been pushing it higher every time the price corrected. The next chart, dollar Indian rupee, a clear cup with handle completed. We have a clear uptrend. So Indian rupee, unlike the other emerging market currencies, stayed a little bit stronger, but still is losing against the US dollar. Even with this latest US dollar correction, emerging market currencies are weak. Now, guess what? We can also apply it on frontier market currencies. This is dollar Kenyan shilling. Classical chart patterns appear also on those price charts. The left shoulder, head, right shoulder, strong breakout, pulled back, ascending triangle here, and then now the rectangle is breaking out on the upside. So this also, the African currency for African funds, should be careful with holding assets in Kenyan shilling stocks. If you want to contact me, axel@techcharts.net. Any kind of questions regarding membership, Jolene@techcharts.net. Thanks for everyone for joining, and I hope this has been a valuable presentation.
It has been, so you don't have to hope.
It was great.
Thank you, Axel. Thank you.
And really, I love the clean look of your charts, and so you trade naked. Just make sure you keep the curtains drawn. Okay.
Thank
Axel?
you.
All right. Anyway, so what a beautiful classic charting presentation by Axel. I believe that we have Daniel Sidnig with us
Yes,
next.
I'm going to introduce actually Daniel, coach.
Okay, and then we have Stephen Goldstein, who I'm really looking forward to talking to today.
That is correct. So
All
Daniel is the, for those that don't know, Daniel is the creator of tradingindicators.com. He's a university professor in software engineering. So another person that, you know, has gone from engineering and computer sciences in trading, you know, something we see quite frequently actually.
Yep.
And he's specialized in designing innovative trading tools for everyday traders. Am I correct, Daniel?
Yes. Hi everyone.
Also a German living in Canada and in love with soccer.
Yes. We did watch a soccer game together a couple of days ago. We tried out the Zoom call. Yeah, thanks, Steve.
Nice to have you with us.
Perfect. Can everybody see me?
Yes, absolutely.
Perfect. Well, thank you so much, Steve, and thank you for the organizers of this fantastic event to give me the chance to speak today. I'm proud to be a sponsor of this event, of a great lineup of speakers. It's been really fantastic and mind-blowing. And I'm happy to have the opportunity to share a little bit of what our story is. what
Perfect.
we do. And we do have also a promotional offer, which I'd like to unveil at the end of this very short presentation.
Absolutely.
Perfect. So I will go ahead and share my screen.
Yes.
Give me a second.
The green button.
Yes. All right. So share. Can you see it?
Yes.
Perfect. So again, my name is Daniel Senek, and I'm the creator of tradingindicators.com. And what makes our story perhaps a bit unique, and maybe not because I just learned that there are other software engineers too, but I am a software engineer by training and a trader by passion. And this brought me always into a very unique position, which allowed me to build my own trading tools. And in fact, many of the tools that we offer through our store is they're based on this premise. We first used them in-house to address a very particular problem that we were facing, and only later on we made them available to the public. So what do we do? Well, as the name, oops, just a second. Okay, as the name suggests, we build trading indicators which can be applied to the chart to help visualize important aspects about the chart, about the trade. And we offer these indicators for various platforms such as NinjaTrader, MetaTrader 4 and 5, and other platforms. We also do a lot of custom algo development. And these are typically done by demand. So we frequently request or receive requests from clients that have an algo in mind, but they're not programmers. So they reach out to us. We go through the requirements of the algo with the client, and then we implement those algos for the clients for various platforms. We also create bigger trading solutions, such as web-based trading dashboards and scanners. And we build standalone trading tools, which are typically geared towards a particular purpose. For example, the automation of backtesting or the analysis of a trading portfolio. What I think makes our product offering perhaps a bit unique and different from your everyday trading tool vendor is that, for example, we have a UX designer as part of our full-time team to ensure that all our products, they are intuitively designed around the trader's needs. Yeah, we love all our customers, big and small. And I'm not just saying this for marketing. It's we really spread the love equally. And just to give you an example, I just recently received a service request from a first-time client. He had an installation issue with one of our tools. And the client was from Turkey, and he did not speak English or any of the languages that we would support. So what we ended up doing is to converse using Google Translate back and forth for hours. It took a while, but eventually we were able to figure out what the problem was. It had to do with the localization of his Windows OS. And yeah, he was able to use our tool. The client was happy, and yeah, and this is what drives really to do what we do. And as mentioned before, is we do use our own tools. Many of our tools are built for our own purposes first to address a particular problem, and only later on released to the public. And one such tool that went through that journey is called the Portfolio Tester 3, which is offered for MetaTrader 4 and 5. And but before this tool ended up like in version 3, it had quite an interesting evolution. In a nutshell, what does this tool do? Well, it addressed the problem that we were facing, which is the burden of backtesting. We backtest all the time. We do custom algo development, and we get backtest requests all the time. Backtesting, however, and everybody who's ever done backtesting in MT4 or MT5 knows what I'm talking about, is extremely tedious and manual. You have to start every backtest one at a time and look at the results once it's finished. And just imagine running a bucket of tests, let's say on 19 different symbols, 3 different time frames, and 6 different settings. Well, you would go to 342 tests, and doing all these tests manually is tedious and painful. So we decided to solve this problem once and for all, and we developed a solution which would allow you to automate all these back tests. So you only specify all these tests at the beginning. The tool will then run all these tests, and at the end, you see the results. So the very first version of this tool, and I show it here, had a very beautiful command line interface, which was perfectly fine because it was used in-house for our own purposes, and we're all software engineers, and the command line just speaks to us. So it was great. And only later on, we realized that, well, maybe if we find this tool useful, perhaps other traders will find it useful as well. So we built a UI around it. This was version 2.0, and version 3, which is the current version that we're offering, is shown on the right side. Oops, on the right side here. And as you may imagine, it's very easy to specify a bucket of back tests. All you need to do is to pick your EA that you'd like to test, then the symbols on which you would like to run the back test, and then the timeframes. And then all you need to do is to click Run Tests. The tool will then start running all these tests while you can go for a walk or you can go sleep. And at the end of all these tests, you will get a detailed analysis of all the test results. And we have this tool for both MT4 and MT5 available. Another tool which went through quite a similar journey was a tool which we now call the Portfolio Architect 2.0. And again, it was based on our very own need that we were facing back in the day, which was to figure out what is the combined portfolio performance of running multiple strategies at the same time. You don't get this kind of analysis using MT4, for example. You can only look at one strategy, one EA at a time. But there's no way to figure out what is the combined performance of running multiple EAs at the same time. And that's, again, a problem that we were asked many times by our clients. And what we used to do back in the day is to export all the individual trades of all those strategies into Excel, then rearrange all these trades sequentially, and then recalculate all these matrices which were important to analyze the performance, such as drawdown, Sharpe ratio, profit factor, and so forth. Again, a very tedious and mechanical work. And we decided to build a tool around this to automate this. And this is when the Portfolio Architect was born. This is the interface. And all you need to do, for example, for MT4, is to drag in your test results into this window here. And they would then be automatically analyzed by the tool. We not only support MT4, we also support MT5, NinjaTrader, Thinkorswim, Metastock, and many other platforms. And the principle is always the same. Just drag in the test results, and you get your analysis calculated on the fly. We have different matrices available, which are all built in. All the popular ones, Sharpe ratio, Sortino ratio, profit factor, and so forth. You can create sub-portfolios. You can export, if you'd like to do so, to PDF for distribution, or even to Excel for further analysis. And yeah, we just find this tool was something that we were needing to do our work. And again, we decided to release it to the public. Hopefully, other traders may find it useful as well. And this is a little bit the journey that accompanied us throughout those years, that tools that we found were useful, we decided to make them public as well. So this sums up more or less my short presentation. I'd like to keep it to the point. But last but not least, I'd like to extend an offer which is exclusive to all Trader Summit participants. And it's the first time we're doing this. So up until October 4th, every participant will receive a 50% discount on any of our tools and indicators and strategies on our online store. All you do is to enter Summit 50 during checkout, and this offer is valid until October 4. So if you would like to take advantage of it, feel free. If you have any questions, feel free to drop me a note. Again, my name is Daniel Sinnick, and my email address is given here. Or simply go to our website, tradingindicators.com, and use the contact forms on our website. We also have a YouTube channel. If you want to see some of the cool videos we produce to explain our tools, they're given there as well. So thanks again for listening.
Perfect. So Daniel, you offer tools both for traders that want to execute their own strategies or just follow their own signals, in essence, their own ideas, but also for people that want to automate things. So that's actually great.
That's how I started. For me, automation is the only way to go. I'm way too nervous, too emotional. The classic gambler. So I must automate. That's the only way.
No.
Know thyself.
Yes, I mean, that is very correct. I know other people that have done that, and some of them actually have managed to do it successfully. It's not an easy thing to do, so it's not like easy for anybody to be able to develop such tools, but you have the experience. You have the know-how, and you've been doing that for how many years?
Many years. It's been more than 5 years. So I'm a software engineer for a longer time, but I've exclusively devoted myself to developing trading solutions for the last 5 years. That's all I do. I write algos every day.
Daniel,
it's the best joy I have.
Daniel, I love what you do, because I always ask people what their most valuable currency is, and they may say, well, it's the euro or the dollar or it's gold, but it's really time. And I'm all for anything that can save people time, and back testing can be tedious. I hope people look into and take you up on your offer. It's a very generous one. Thank you for being a sponsor of our summit.
Yes, thank you very much. It was a pleasure having you, Daniel.
Yeah. Bye-bye. Bye.
Okay, on deck, someone I'm looking forward to talking to that I haven't before. I don't know how he slipped through my fingers. Maybe Stephen's not active on Twitter. That's where I find most of my guests. But for those of you who don't know Coach Goldstein, Stephen is one of the financial market's leading performance coaches. His specialty is helping people to achieve transformations that lead to greater effectiveness and stronger risk processes. We all know how important that is, the difference between pros and amateurs. Our pros know how to lose, so they have money left to be right with. And he's kind of combined his coaching techniques to some psychotherapy studies. So, one day I'd like to spend an hour on the couch with you, Stephen, and I want to welcome you to our trading summit. And over the past 10 years, and I can't give this out until our next interview with Jack Schwager, but over the past 10 years, Stephen has coached some of the world's leading traders. So your methods and your caring about people that are attempting to make it in a very difficult endeavor, I applaud you, Stephen. And, it's everyone that I've talked to throughout my career has had a great mentor, and welcome to our summit today.
Thank you very much. And it's a very kind introduction, Dale. So thank you very much indeed. And what a great summit it's been so far. I've managed to catch quite a few of the sessions. So it's the quality has been outstanding, and I feel quite honored to be actually able to join you.
Do you have any kind of presentation developed, any kind of PowerPoint that you want to share with us, or are we going to have a conversation?
No, I've got a PowerPoint here. I'm just going to hit the share screen button, and we should be good to go. So,
and you're located in the UK?
Yes, I'm in London. So,
okay, yeah, and there's the show. Is this a show, a podcast that you do called Tipping the Odds?
No, it's called the Alpha Mind podcast.
Oh, okay, all right.
I just decided to give this the title Tipping the Odds.
Okay, all right.
I'll explain that as I go through it. So, and
it's all yours.
Yeah, if you want to stop me at any time, just ask a question. Do feel free. I've got quite a few slides here, so I'll try and get through them without chucking up the show. So
don't worry about it.
Okay, so first of all, thank you and good morning to all of those of you based in the Americas, and good afternoon to the rest of the world. As Dale said, my name is Stephen Goldstein, and just to give you a little bit more insight as to who I am, I was an investment bank trader for 25 years, started in the mid-1980s, and I worked both in market making and proprietary trading roles for banks such as Credit Suisse, Commerzbank, and the banking arm of American Express. I was involved in the rates and FX world, and I've been a performance coach since I decided to make the career change in 2010. And as Dale said, I follow certain philosophies and use certain psychotherapeutic methods which are allied to my knowledge of markets and risk and what it's like to be a risk taker and a risk manager in the markets. And my clients cover really the whole spectrum of the markets, right across the different product types, and from hedge funds to asset management firms to investment banks and energy commodity firms, retail traders. So it's it covers a pretty broad spectrum. So the purpose of this talk is to really explore and raise awareness of how traders and investors can achieve improved performance and better results by developing their risk philosophy, their risk processes, their risk skills, and ultimately with the aim of trying to achieve more regular peak performance. So why do I call it tipping the odds? Well, this is simply the idea that the odds of success are stacked against you, and really they remain so throughout your career. You have to be at your best the whole time. There's no there's no second chances, and you know, it comes against this idea that, you know, the counterbalance to having the odds against you is to be mentally at your strongest as a trader or a risk taker as much as you can be. And this is the same for any field of performance. And I consider trading a performance activity. So if you enter sport, gaming, music, the arts, whatever you do, you know, you could be good, you could be very good, but to achieve sustained success in any of those fields, you've got to become outstanding. And that's the same in trading, and you've got to put in the hard yards. And those who do, and those who go that extra mile to help themselves become outstanding are the ones who succeed. You know, they're the ones who have superior risk. They've developed superior risk philosophies, processes, skills, and you know, they're the ones who are best placed to succeed in the long term. So I believe that, you know, and I try to work with people on helping them get past some misconceptions, which I think run deep within the industry and within most traders. And that is that success comes down to intellect or knowledge or strategy or ability to predict the markets or having better data. And I feel those are a fallacy. Those are important. They do matter, and I don't want to diminish them in any way. But as I say, it's about developing risk skills and risk abilities. And, you know, those elements, they're vital inputs and they all matter. But I like people to see them as what they are. They're inputs into the process. They are not the process itself. And this is where I feel so many people go wrong. The process is a risk process. The game is a risk game. And the skills are risk skills. And I use poker a lot to make analogies, because I try to say a great poker player doesn't win because he knows the value of the hands or because he has superior information from everyone at the table. You know, in high stakes poker tournaments, you know, in these games, everyone knows the value of a hand. And everyone gets the same cards, they know the rules, they're playing the same game as everyone else. But the best win by repeatedly, they don't win every time, of course, but they win more than everyone else because they've developed the skills needed to win and to keep on winning at an extremely high level. And that they're peak performers in the poker skills. You know, they have the mind of great poker players. They have the mind skills, the mental skills, the pot or money management skills, the risk skills, and they've learned to do it when the pressure is on. So in this talk, it won't be any market views or tips or insight about what's happening in the markets. You won't get any new insights from me about systems or strategies or methods. But hopefully you'll get some new perspectives about developing yourself as a trader and thinking about that side of it and what you can do. So you can start, you know, this could be a catalyst maybe for you improving your odds of success both now and in the long run, or pushing past some sort of barriers or hurdles. So I want to start by focusing on the human aspect of performance when trading, and about how ourselves and how we get in the way of our potential. And God knows that was something that, you know, I got in my way for so often during those years. Now, there's a famous quote which I use a lot, and it's attributed to the mountaineering legend Sir Edmund Hillary. And the quote says, "It's not the mountain we conquer, but ourselves." Yes. And for me, this quote captures the essence of the trading challenge. I like to paraphrase it as, it's not the markets we conquer, but ourselves. And this was most dramatically brought home to me a few years ago when a new client came to me he was a hedge fund trader, and he'd been working for about 3 years in this hedge fund, a large global hedge fund based in the UK. And before that, he was an investment bank trader for about 12 years, been phenomenally successful, and he was very sought after by the hedge funds. And he decided to make the leap over to the hedge fund world. But his performance had really struggled. He'd not been able to replicate what he was doing in the banks. And he came to me after the 3 years were up and said to me, look, if I don't crack it in this 4th year, they're going to let me go. He said, I'm just about hanging on by a thread. So fortunately, this client was a very diligent record keeper. He kept records of every trade idea he wanted to do, everything he wanted to put on, how much he wanted to put on, how he thought the scenarios might play out once he's got the trade on, what would cause him to get out, what stop levels he put on, where he'd look to take profits, those sort of records, which was a gold mine. And I said to him, well, can you go back over the 3 years and rebuild your portfolio along those 3 years as if you'd executed everything you planned to do, and let's see what your performance would have been. So, I mean, this was kind of back testing, forward testing, if you know what I mean. It was a chance to really see what had gone on. And he came back to me, and this is merely a representation of what happened over those 3 years. But theoretically, his performance had been around 40% during that time, which was, that's pretty great performance.
I wouldn't cut him loose.
Yeah, but that was a theoretical performance.
All right.
This was his real performance. He'd averaged around about 4%.
Interesting.
And whilst that is a representation there, his volatility was actually better on the theoretical number than his real volatility was on his actual number. So, even the metrics were against him. And the point about this, and I use this as a great analogy, is to say that this difference, this represents money that he left on the table, and a lot of money that he left on the table. And how I define this is it's a behavioural gap. It's not an information gap. And the information was in the theoretical returns, what he wanted to do. This was in his actual performance. He just wasn't able to execute what he said he was going to execute. And this is a great, this analogy works for just about everyone I meet. It worked for me as well as a trader before I had coaching. And the aim, therefore, when you work with someone, is to try and help them in some way close that gap a little bit. I mean, to be honest, it probably wasn't realistic to achieve those sort of 40% returns. The reality is that, if you get anywhere close to even half that, it's a fantastic performance. And actually, the following year, he was able to return 15%, and he's still there now. So, he's done pretty well working on that. But this is the aim. This is what we're trying to do. And this is what everyone should be trying to do all the time. Trying to get that actual performance up, even if it's just in small increments over time, pushing it that way to try and close that behavioural gap. And I would say that's very much the essence of what I try to do when I work with people. So, as I said, performance improvements does not come from more information, more data, a new strategy. Of course they help. If you can improve all of those, or even better analysis. Because the point is that those inputs, they were already in a theoretical P&L. They were already there. He was already doing good. He was already doing well on that stuff. He just wasn't able to turn that, to monetize that.
It's all in our heads, huh, Steve?
Absolutely. So this performance improvement comes from self-improvement. And there's another kind of story which you'll probably all, I'm sure most people are familiar with, which also exemplifies this, which is the trade at the turtles, the very famous experiment started in 1983 by, I think it was
Richard Dennis.
Richard Dennis and Bill Eckhart, yes. And I'm sure there'll be some people listening here today that aren't familiar with that. It was an experiment. They were, at the time, they were visiting a turtle farm, I think it was in Singapore, that they were looking to invest in. and they just commented, one of them commented to the other, that, you know, do you think we could grow traders like they grow turtles here? And it led to this famous experiment, which I think also became the basis for the film Trading Places, or the inspiration. The experiment itself was, no one ever decided whether it was a success or not. You know, they hired a number of traders that they selected. They gave them capital to trade with. They taught them the system. They put them all into the same markets, and they even managed their risk for them. So all they had to do was execute the system they'd been given. And I think some are spectacularly successful, the most famous being Curtis Faith, who wrote a great book called The Way of the Turtle. And there were a few others from that group who achieved great success. But a lot of them just achieved mediocre performance. And I think about half of them didn't achieve any success at all, which really shows you, I mean, it's a great metaphor, again, for that the system is the potential. And it's up to you to really try and monetize it. So I've got a model, which I'm going to show you in a minute, which I'm going to take you through some ideas around this. But this comes to this point that there's potential, which is often in the method, the system, the analysis, the strategy. And then there's interference, which is what gets in the way. And that's what impacts performance. There's lots of different forms of interference. And we can readjust these a little bit, because there's an equation here. Performance equals potential less interference. And that came from that graph there. But some people who know the work of Tim Galway, who wrote the inner game of tennis, that's his performance equation. So it's this area of interference I'm really curious about when I work with people. So I created a model which comes from psychotherapy, but I've adapted it for the markets, which looks at everything we do as a cycle. Whether it's one trade, whether it's a series of trades, whether it's our work, there's a kind of cycle going on, a cycle of different experiences. And I've applied it to the trading process, to form a trading process, which I call the risk process cycle. And I'm going to take you through that to kind of try to exemplify some of the ideas I have around this. So this is the bear cycle, we could call it the naked cycle. And just think of an example of a very simple trade. So let's say you've been out the market for a year, you've decided to travel around the world, you walk in on the 1st of January 2022, you ask your guys, anything happened last year? I've been traveling. And you know, they'll give you some feedback, some information on the markets, and you'll start with that. And then what you're doing now is you're following the market, you're reading news, you've got a starting point. And what you're doing here is you're sensing the market. So this is the first stage of the cycle. And this, although you do it consciously, this is largely an unconscious process. And what you're doing is you're scanning, you're observing, you're looking at the data, the news, the insight, the opinion, you're looking at the charts, you're reading research. And as you're doing this, you're giving out, you're asking questions, this is all coming back to you in signals. And I like to use the example of a satellite dish. You know, we are satellite receivers, taking all of this coming back at us. And obviously, if we lack curiosity, it's not going to be as good, it's not going to be as effective. This is why curiosity is, for me, one of the traits of great traders. If you lack open-mindedness as well, this is also going to impact the quality of what's going on here and what you're receiving. And again, open-mindedness is one of those traits for me of great traders. It's almost the counter to the perma mind, whether you're a perma bull or perma bear. This is saying, you know, if the markets go up, I'll go bullish. If it go down, I'll be bearish. And we can switch on our open-mindedness often, or switch it off rather, when things happen in the markets. So what happens is you've got all these signals coming at you, all this data coming at you rather, and then something happens. You feel something or you think something from everything that's going on there. A signal occurs on your, call it your satellite dish, your screen that's come in your head. And that, you notice something, you feel something, and you're curious even more about it. What does this mean? Is it an opportunity? Is it a threat? Should I be hedging something? Should I be adding? Should I be starting a new position? You don't really know. You've just felt it at that point. And now what you want to do is make sense of it. That's what we all do. So just quickly, this cycle, it doesn't have a time limit. It could be seconds, it could be weeks, it could be months. It's not relevant. So what you do is you start a process called sense making. You're trying to look into it. You look at maybe at the charts, maybe you look at the macro story, maybe you look at the stock, what's going on behind it. Like I say, what does it mean? That's the important thing. So you're creating at this point a narrative, because we all make and build narratives. We all trade in stories. You know, I was just watching your guy with a technical analysis, and you know, there's a head and shoulders here, it's broken a line here, it's broken a line here, this is a great level to get long. You know, there's a trend line. That is a story, that's a narrative. That's what we do. So we form these narratives which give meaning to the scanning activities. And we're constantly forming these narratives all the time. And these enable us to form a more complete picture. Part of the danger, again, the risk here with sense making, is it's informed by our core beliefs. And if our beliefs are compromised, or they're off for some reason, or we're stuck in an old belief that's not healthy, it's going to affect the quality of our sense making, and then going to affect the quality of the narrative which forms. But this is just to sort of exemplify this is the next part of the cycle, the blue part. This is the conscious part. This is where you're doing some thinking around this. We move on to the next stage of the cycle. This is the conceptualizing and planning stage. So at this point, you're taking this narrative that you formed from the sense-making stage, and you're moving towards some sort of action. So you're planning your risk, your size, your entry, contingencies for the trade, maybe the stops to take profit, where you're going to add maybe, or maybe even planning just to wait and give it time to play out a little bit, see what happens. Maybe it's not right for you, so maybe you won't act at all. Again, a point here, this is a cycle, so the quality of this stage does depend on the quality of the stage before. Every stage depends on the previous one. Now this left-hand side, what we've got is the left-hand side. So we've now moved to the action point. So this is, there's 4 key stages on this, 4 key action points. And they're at the quarterly, the 3 o'clock, 6 o'clock, 9 o'clock, 12 o'clock. So we've reached the second key stage here after the signal. We're going to move to action. But I want to make a point about this now, which builds upon something I said. It's about, and I use another analogy here, you'll hear these metaphors and analogies all the time. This is about the high wire analogy, or crossing a beam. Okay, when we trade, when we're learning to trade, it's like if we learn on a simulator, or we do it in small size, we're learning to do the job just a couple of feet off the ground. If we fall, we're not really going to hurt ourselves too badly. But when we trade, when we go on to risk, when we put trade on, it's like raising the rope. It's increments, 50 feet, 100 feet, maybe even 200 feet. It gets more and more dangerous with more and more risk. Even if you've got a harness on and you've got a safety net on, you won't be trading the same. So what happens when the more risk goes on is our mind becomes triggered. It becomes anxious. The crossing of the wire or the beam is exactly the same mechanically. 2 feet is at 200 feet. But our mind is triggered. It's when you're vulnerable and you're exposed, that's what happens. It doesn't work in the same ways. We cross that rope with a lot more care, possibly more clumsily. We're not going to do the job in the same way. This is what happens when we move from the left side of this cycle to the right side. And the left side of the cycle, a little bit like the learning side, it happens just 2 feet off the ground for the sake of the metaphor. Risk is low. What then happens when we cross to the other side is we're now going to the action side. And here, the risk is high. And I use the analogy or the comparison by saying that we're crossing this tightrope 200 feet off the ground. We are at risk. And we're not going to behave in the same way. And this is where this gets difficult. This is where this gets challenging. Because at this point now, we're engaging with risk. And a lot happens, and often a lot goes wrong during this transition. This is where I see so many people, really the source of failure is here. The source of problems are here. Just going to, again, come back to this idea of performance equals potential less interference. This is where one of the big sources of interference is coming in. So for example, just a couple of examples, if you fail to execute as per your plan, you are creating slippage. And anyone who's built a system, a systematic, non-discretionary trading system will be familiar with that. But we have also, we have discretionary slippage, which comes from that process. Or if your plan was already compromised, if the previous parts of it weren't wrong, you're putting on a faulty plan. It's probably never going to work. And maybe you're just not even sure of that. So there's lots of interference which comes through at this stage. I've just given you a couple of examples. But this point here, which I'm trying to make, from 12 o'clock to 3 o'clock, this is the game. The left-hand side of it is the inputs. That is not the game. And a lot of people mistake that for the game. They put a lot of energy and a lot of emphasis and a lot of learning into improving their analysis, getting better analysis, building a strategy, building a system, testing them. It's the monetizing of the system and strategy that matters. That is the entire game. Well, that is most of the game. That is on this right-hand side. And as we say, once you get here, there's a lot happening, a lot going wrong. So the next stage is full contact with risk and disengagement. We're doing this 200 feet off the ground. We're a victim of the market here. As the market goes up, it's gone our way, we'll feel high confidence. And it goes against us, we'll feel low confidence. It's putting us through the rinser here. We're going to have self-doubt. We may panic. We may have fear controlling us. We're not seeing it in the same way. Greed, ego. There is a lot going on here during this stage, which I obviously colour red, because it's a cold, hot state, versus blue, which is really cold state. This is where you've got skin in the game.
Stephen, do different people have different emotional reactions once money's involved? Say, for example, they grew up poor, or where, they, all right, so it's me. Grew up poor, yeah. And so they have this scarcity type of consciousness, or someone who had a silver spoon, who never really had to worry about money, maybe would, not be as careful about risk management. So does a lot of this have to do with our paradigms that developed real early in our life?
100%. In fact, when I work with people, it's the first thing I explore. Not just what was your history from literally from birth. What was your parents' history? What was their values? Because if you've got a father or a mother who had scarcity all their life, they're going to pass that on to you. They're going to give you advice. They're going to make recommendations. That is going to come down to you. You'll have a lot of baggage which comes from the past.
Yes,
it comes into how you work, and it's a big blocker for some people. It's just guilt.
I actually think like one of my trading weaknesses is not being able to hold my trades until target. Probably comes from I could still see being in the grocery line with my mother. She raised us, a single parent, and her anxiety level rising as the register continued to rack up prices. And so for a very big part of my career, I would always take profits too soon and then just rationalize it because Bernard Baruch said, I always sell too soon. But it really is a handicap that when you work real hard for the first 40, 50 pips and you get out of everything instead of leaving a piece on, and then the windfalls come, it's difficult.
Do you know what? I have some people who still told me that they're still haunted by the fact that their grandfather lost everything in the Depression in the 30s. And it's haunted.
Generational, passed on.
Yeah, I mean, these traumas live and carry on through you. They're passed down to you when you're not even conscious of it as a young child. We don't come to trading as a blank sheet ever. We've got, for want of it might not be the quite correct phrase, but we have this default operating system within our mind, which is pulling the levers on a lot of what we do. So, and they don't go away, much as we can tell them to. They don't. So we have to, you have to try and work with that. And I've had some great stories of you know, people that have managed to get past that. You know, it's still there, but they you know, it's as I always say, the volume is turned down on it. You know, and the volume is turned up on other areas. You know, you can't just erase it. You can turn volumes down and up. But yeah, so
okay, so you really have to almost create a new paradigm for yourself, don't you?
You have to work with it, yeah, but it's very hard because you're not even conscious of it. This is the problem. You know, this is happening out of, this is in your subconscious, which, you know, it's a strange place and none of us know what's going in there. But it's almost like it has been programmed.
Anything inside my head is a strange place, Steve. Anyway, go ahead. I just wanted to bring that up because I know a lot of traders. I just wanted to tell a little bit about my story. I'm not trying to get a free session, but I have noticed that for years, I had first daylight syndrome, which is you have some money made, take it before the market takes it away from you. And I'm sure that there are multitudes of traders that have the same issue.
Well, you know what? I just had Morgan Housel on the podcast last week talking about his new book, Psychology of Money, and you can feel that features throughout the book. You know, his relationship with money is so vital. And he said, I do things which aren't classic behaviors that you're told you should do in kind of investing 101, because, you know, you have this relationship from money which goes back to your past, your history, and you'll never lose that. That is who you are. One of the philosophies I learned family therapy from, and one of my teachers said that these family traumas can go back 7 generations, and they're still within a cultural memory that's affecting you.
Wow!
And we don't even know about them, but they are there. They're transported, and you know, we don't even know where they come from, but they just get passed down through the families.
Okay.
So it's an interesting place which you just went to there. Anyway, so just moving on to the next part of this, so the 3 o'clock position. So this is withdrawal from whatever was prompted by the original signal, which first came up from the scanning. This for me is another key point, because we move into what I think is the stage where I notice the very people who are the most successful have got it mastered. That is letting go, and that's mental closure. That's what they do better than anyone else. And I've worked with some outstanding traders who are just brilliant at this. So let's say you've disengaged from the trade. You've either taken your profit or you've booked a loss, whatever it was. You're sitting there now going, I should have put more on. Why didn't I stay with it a bit longer? I should have got out earlier. Why did I do that? Why? You've got all these self-recriminations and self-judgment going on. And it's not healthy. It's healthy if you learn from it. It's healthy if you can do it in a non-judgmental way. Okay, so what can I take from that? That's good letting go. That's good closure. And then you can move on. If you're beating yourself up, if you're berating yourself, you're just undermining yourself. And I see so much damage comes from people not able to get good closure. You know, entire careers at times can be ruined from this. And it's not just closure from the trade. It's letting go more generally. As I say, this is a super skilled traders, which I just meet all the time.
Athletes too, right, Stephen? I mean, what quarterback that throws an interception comes back into the huddle when they have possession again and goes, oh, guys, I really blew it. I should have done it. The key word, I think, for traders is next.
Well, it's actually should have. Should have done this. Should have done. It's when the should have.
Should have anything. But next is a key word because that's giving you closure and it's on to the next, right?
When you can put a line under it and then move on. And when you really move on, you get to the next bit. And this isn't always a bad experience. It could be a good experience as well that you don't move on from. So if you've suddenly made a lot of money in a very short period of time, we are so attached to our ego that that's when we're often at our most dangerous at giving back. And you may have heard of house money. You know, we do it because we relax. We believe in our own superiority. And then we don't move on properly. We don't do the scanning and sensing because we think we know what's going on. So this is the next bit. This is the moving on. And this doesn't seem important, but you have to pass through this. And you have to pass this because your next cycle depends on it. If you haven't gone through that next cycle properly, if you haven't gone through this properly, you're in trouble, because the next cycle builds. And this is a process orientation. This is why risk process is so important. You know, don't judge your results. Don't base your outcomes just on your results. It's more important, did you stick to your process? Did you do good process? You know, you can have a lucky outcome that gives you a good win, but you may have really followed a bad process. And the danger is then is that you keep following a bad process because it produced a lucky win. So you mustn't mistake your outcomes, your results. You have to have a process orientation. Now, there's a lot more to this model, and there's a lot more layers to it. This is just sort of touching on the top of the upper layer and sort of quickly introducing it. But the important thing is to be really present as you go around it, to try and be as present as possible at each and every stage. And the less present you are, the more you're lost, and the more you're likely to go on to tilt as a trader. You're likely to make mistakes. You're likely to fall for the classic errors which we all fall. We all fall for. So this is, as I say, it's about developing peak performance. And I'm just emphasising this point. This side, this is the inputs into the game, but it's not the game itself. They matter, but the game is not won or lost here. Now, if you're an analyst, this really matters. But if your job is actually to monetize risk and make money out of it, this is not the important part. And yet, this is where most people spend most of their time in. This is where perhaps 99% of time and effort and energy is put here. Very little goes onto this side. This is the game. This is where it's won or lost. And I ask traders, and guys who have been doing it for years in hedge funds, I take them through this. And they say to me, wow, I've never thought of this. And actually, I'm very weak on this side. And when I talk about numbers, most people suck on this side. This is why we get wrong. We never really develop ourselves. You know, I had coaching in 2000. I was a trader at the time, Commerce Bank. I was taken to this executive coaching program. It was the best thing that ever happened to me. And I came out of it and I really realized that, you know, I'm really good on the left-hand side. I'm really good at finding value. I'm really good at analysis. I love technical analysis. I love the fundamental. I loved that side of the game. I loved looking for good wins. But actually, I wasn't very good at monetizing them. And so I really became conscious of how weak I was on this side. And that became my project. Project Me for the next couple of years was to develop these aspects, and my performance significantly improved in the years afterwards. And part of it, for example, was my relationship with losing. I had a horrible relationship with losing before that. I considered it failure. And when you have that, you're not willing to lose, which means you're not willing to put a trade on, or you're going to be too nervous. And I completely reframed my relationship with losses and losing. And then I was able to put more risk on and to sit with it longer and to allow things to play out. You know, my years after the coaching were far better. Now, I'm not going to say they didn't have their downsides, down periods. They did. You know, that's the nature of this game. But I bounced back far more quickly. I was far more resilient after that. I was far more able to actually load up on risk when I needed to. So learning the right-hand side of the game, that is the game. And that's what the greats do. And I'll often, when I work with people, I'll ask them to go around this with me, and we'll gauge a score out of 10 how they are. And they start off with high scores. And as we move round this cycle, the scores get progressively lower until quite often, you know, they're saying as a closure, I'm probably a 2 out of 3. And you know, so if you could just get yourself to a 3 or 4 or even a 5, well, then you're suddenly, you know, things are going to change a lot, because there's not many people I come across who I would say are higher than 5 out of 10. There's a couple of guys who I consider champions who are 7 or 8 out of 10. They're incredible traders. And they are so good at moving on, at just letting it go, learning from it, moving on. They are so rare. But, you know, even if you just get yourself, again, turn the volume up over time, become a 4, become a 5, you know, occasionally a 6, you're gonna see the results in your P&L. You're gonna see the results on that actual curve moving up to the potential curve.
I have a couple of questions. One, and we get this a lot, you know, a lot of people have a desire to become a full-time trader. So Louis Azar asks, trading is my second job. Unfortunately, and I cannot dedicate all my time. So what is your advice to people like me? I'd like to leave my job and be a full-time trader, but it's very risky in my opinion. What do you think?
Oh,
That's my question.
well, it is the paradox. And I've got some people who I work with who are going through this at the moment. I would say that do not rely on trading for an income for 5 years at least. That's my own opinion. I know some people who do make it quicker than that. I know a lot more people who've made it taken a lot longer than that to get there. But I coach. You've got Jack coming up soon. I've got 3 traders I've coached are featured in his new book.
Oh, you just spoiled my secret.
Oh, sorry.
That's all right, Stephen. Anyway, the others is Stephen. Do you teach the building of the right side in your training? Is that where you focus?
The important thing is it's not teaching and it's not training. It's coaching. So we
coaching.
But that obviously comes into it. If people are weak on those areas, I do try and get them to understand the importance of working in those areas. But as a coach, I'm not someone who's transferring my knowledge and skills to the person. There's an assumption they've already got quite a lot of knowledge and skills already. What I'm working with them is we call it a co-creative process, where we explore everything they do together. And if that comes up, if I feel their risk processes are, that there's something which I consider wrong, I'll explore it. I don't want to just tell them it's wrong because they may have a reason for doing it the way they do it. I had a reason for doing it the way I did it because it suited me. So I'm not just going to tell someone, tear up what you're doing and do it wrong. But let's explore whether that fits into, what's kind of a good paradigm or a good philosophy for risk. And if we can adjust it, let's see what we can do. Let's see what we can work on. So I've got some workshops which I do occasionally, and I'm doing some with a company at the moment. But that would be, part of the problem is I've seen just about every single style of trading that I've worked with people, and I don't want to turn around and ruin their style because every single one of them seems to work in some way for a person. I've met people who do trading that when I traded, I thought, no, that never works. And I see them making it work. So I don't want to corrupt how someone's working. I want to explore with them and then see what we can do to improve it.
Have you ever, Stephen, coached people that were successful traders and also had maybe another vocation too, or the people that really made it, trading was it was their solo focus? Because Richard Dennis, who was successful, had C&D Commodities, which was a clearing firm and generated income for him, and he was a great trader.
It's a tough question. I do work with some that have had other jobs. They tend to take more longer term risk. So, one of the reasons I do this now is, I stopped trading for a company and started doing it for myself at home. And then I started doing coaching. It was my former coach suggested I should become a coach. And I started doing coaching. And the idea originally was I was going to trade and do my coaching job. I couldn't do it because I was a full-on trader. That's how I worked. I was, screens first thing in the morning till last thing at night. And I was trying to do both. And I was going into companies and I was away from the desk and I wasn't following the price and I couldn't see the price. I thought, I can't do both here. That's just for me. I know other people. But for me, I believe you have to do one or the other. But I also believe that in the early years, you don't want to rely on income from trading because it's going to force you,
you'll be too emotional.
Yes, yeah.
So we have a couple minutes left here, Stephen, and I wish we had a few more hours left. Really fascinating look, and we're getting things like to thank you for talking about the right side of the training that you do, and are you open to, if we had any viewers or people that are attending now or see this later to taking on new people?
We're only taking on at the moment a couple of months for now, because we've got a little bit of a backload with some corporate work.
Okay.
But we are, and some people are starting in November or December, some in January. So but at the moment, yes, we are taking on, but like I say, we've probably only got room to start 2 or 3 a month at the moment.
Okay.
Just sharing details. Is that coming through?
Yes, we've got your email address there, stephen.goldstein@alpharcube.com.
That's right, yeah. And if people want to reach out and email me, we can get back to them. I've got a podcast as well, as you see, it's the Alpha Mind podcast, and a Twitter handle there. So we can connect on Twitter as well, Dale.
All right, Stephen.
On Twitter.
Really a pleasure meeting you, and I wholeheartedly agree. I have an expression, just like real estate is location, location, location. Trading is psychology, psychology, psychology. And I tell you what, I think you open people's eyes to it's not as much about the left side as it is about the right. So great presentation. We appreciate you being here.
Thank you very much.
Thank you, Stephen. It was great.
Okay.
Thank you very much.
Outstanding.
Thank you, Stephen.
Now, what I've been waiting for 3 days now.
Rita, because we have. Rita.
Yes, of course. That too.
Yes. Let me see. I see she's here. Rita, you can unmute yourself. There you go.
Welcome, Rita.
Hi, how are you guys?
Hi.
Good.
Don't
Hi.
worry, I know IRAs are exactly what you were waiting for because it gets everybody going. So just to introduce myself, my name is Rita Woods. I'm with Midland Trust. And thank you guys so much for having me. Midland Trust is an IRA custodian. We take care of alternative investments inside of IRAs. And so when we were actually told about this Forex Trader Summit, we were really excited to be able to kind of further explain what IRAs are able to invest in, which is Forex trading, of course, but more or less be able to be a value add, hopefully for our listeners here, that if you were ever considering using IRA funds in order to trade Forex, that this is definitely a possibility. We're here to streamline that process. And so really we want to be seen as a resource, questions, issues. When it comes to IRAs, we should have the answer. So just to start off with, a little bit about Midland. While we are an IRA custodian, that is the majority of what we do. We also have a couple other sides of business. We, are a qualified intermediary for 1031 exchanges. We also take care of fund custody. So we're a custodian for private funds as well. Midland IRA, Midland Trust, we're a trust company now. We have locations in Chicago, which is where I'm located. Fort Myers, Florida is our headquarters, and then Sioux Falls, South Dakota as well. We have, over $2 billion in assets. We have 15,000 account holders. It says around the country, but really it's worldwide. We have plenty of expats who have decided to retire abroad, or clients who have been up and moved because of their jobs, and so they're international as well. What we do is to make sure that all the elements of the administrative work for an IRA are met by IRS requirements. So the rules and regulations behind it, that's what we do. We know everything behind it. You guys can rely on us for that prospect while you are taking care of all of your trading. So we file all the reports on behalf of the IRA. What we don't provide, just to be clear, is we don't provide financial, tax, or legal advice. So we're never going to be here saying, hey, have you considered this new fund? Have you looked at this new trading firm? Or maybe have you considered the price of gold today? We're never going to be putting anything in front of you as our customer. So as many of you guys already know what the benefits are of an IRA, you're building your retirement and you're building it faster, hopefully in a tax-free or tax-deferred status. So IRAs, Roth IRAs, traditional IRAs, 401ks, those are all great tools in order to put money away without paying tax on it, if it's a traditional or a 401. You put that money away and you are able to start investing it. It starts to grow a little bit faster. When you have a traditional IRA, you're able to take tax deductions on it. If you have a Roth IRA, you are knowing that when you take out that money, when you retire, there's no tax on it, including all the gains. So really, this is just getting your mind ready for what kind of savings am I actually preparing for my retirement? Because a lot of times it's out of sight, out of mind. Your 401k is something they take from your paycheck, this X amount, and this is this match from the company. But really being aware of what your possibilities are is really the first step in self-direction. So as I'm sure everybody knows, if you were to save money with a tax-free or tax-deferred account, you're of course going to make more money year after year compared to if you were going to put that money in, let's say, a savings account after it was taxed from your paycheck. So what you're looking at on this graph, and this is for purposes of it's in the same exact investment and you make the same exact returns. So the blue one is obviously non-IRA. The orange is the IRA. When you don't have to take out your capital gains every single year, when you don't get taxed on the gains that you made, that just adds to your new principal and it keeps going higher and higher. I mean, that's the premise behind an IRA or a 401k in general, but sometimes you kind of need a graph to show you just how wild that difference can be. So I'm sure the IRA history isn't going to be that fascinating to everybody else but me, but what I do want to point out is that IRAs were created in 1974. The most popular question I get asked on my end is always, well, when were self-directed IRAs created? 1974. So you've always been able to self-direct your IRA. You've always been able to put these investment or IRAs into alternative investments. The fact is, and this is going back to Q2 of 2019, and then several years before that. But the fact is, most people have had their IRAs invested in mutual funds. So when you look at 2000, it was about a good 50-50 that just mutual funds alone made up 50% of Americans' IRA investments. That's just one product, was mutual funds. As you see in 2005, it actually eclipsed all other investment types. But as we know, with the Great Recession, people had to think outside the box. Forex traders are a perfect example of that. So people start thinking outside the box. You're able to hold Forex trading accounts inside of your IRA, futures, precious metals inside of your IRA, real estate, private hedge funds. The list can go on. But people finally started realizing just what they could do inside of their account. And you can see throughout the last couple of quarters, let alone the last 10 years, just how much people were diversifying and still are. So I get asked all the time which retirement account is best for me. Now I can tell you, when it comes to your situation, which ones you're even eligible for, I wouldn't be able to pick out the one that's going to be the best for you. It's going to come down to probably your CPA, just because you're also having to take into consideration that you need to have your personal taxes assessed. So your modified adjusted gross income has to be assessed when you are deciding. But we hold every single one of these kinds of accounts. So a traditional IRA, a SEP, or a simple, those are all pre-tax accounts. So the money goes straight from your paycheck into the IRA. There's no tax on it. Tax only gets hit when you finally take personal distributions. Roth IRA is going to be the opposite. You pay the tax now, you get the money in there, but when you take that money out, it's completely tax-free. Again, doesn't even matter if you made 3 times as much as what you started off with. That's the point. You're paying the tax now, so you don't have to pay it later. So again, this is all possible with whatever investment choice you have, including Forex trading. Now, the 2 that I wanted to point out in particular is the SEP IRA. SEP IRA, you're still actually able to make a contribution for 2019 up until October 15th of this year. So you're still able to backdate an entire year and still do a 2020 contribution as well. And then an individual 401k. Now, I point those 2 out because those 2 are for self-employed folks. If you're self-employed, you're able to put in much larger contributions of, closer to 57,000 compared to, let's say, 6,000 or 7,000 if you were going to have a traditional or a Roth IRA. So food for thought on that as to which one might actually be best for you. So you kind of have to ask yourself, why do you need Midland? Why is a company like Midland even sponsoring an event like this? In order to have these types of investments inside of an IRA, in order to have any investment with an IRA, the IRA has to be held by a custodian. We're an IRA custodian, and we are not a brokerage firm. So Schwab, Fidelity, E-Trade, those are all companies that are brokerage firms and IRA custodians, but they'll only allow you to invest in their product, what Schwab has to offer. Forex trading is not one of those things. We do not offer you any investments. You come to us and tell us what you want to invest in. And so therefore, you're able to do any alternative investment you'd like. So you need a company to be the tax reporter, which is what we do. And in order to go alternative, you need to go to a self-directed IRA firm. And, there's plenty of companies that do what we do. We are, one of several IRA custodians that go into alternatives. But why use Midland? We were invited here actually to host or to sponsor and to talk because we have actually worked with Forex brokers before. We work with brokers, we work with the trading firms themselves, and we work with one-on-one with the clients. So on our end, we've always had a great rapport with the professionals as well as the personal traders. And it's something that I think speaks to Midland, is that we make the process easy and we're always there for client support whenever it's needed. That's really our strength. That's really what sets us apart from any of the other companies that do what we do. We think we do what we do and we do it well. And we know that when it comes to brokers, they've always sent business our way because they've felt the same way, that their clients are going to be treated the same way that they would treat their clients. So a lot of times
I can definitely testify to that, Rita, because Justin has spoken, in the best possible way for you and your company.
Yes, thank you so much. It's probably the majority of how people hear about Midland. We don't do, ads. We don't do billboards. We don't do targeted ads on Google.
Word of mouth.
Yeah, it's really word of mouth by client to client or from broker to their client to tell them, if you want to do this, I have the company for you, but you have to go alternative. You can't go with Schwab, unfortunately. Yeah.
And Rita, I was going to say, and hello, my name is Blake Morrow. I wanted to say, as a currency trader in the United States, there's not a lot of options available, and there's so many traders, especially here in the United States, that didn't even know or don't know that they can trade in their IRAs or tax deferred vehicles. And so this is a really big eye opener, I'm sure, for a lot of traders that are listening in right now. And I think it's a huge service that you guys offer. Obviously, currency traders might think, well, I'm going to, I trade currencies, so I might be using a little bit more leverage than maybe I should be using in my retirement account. But remember, as a trader trading currencies, you don't have to use a lot of leverage. you don't have to apply a lot of leverage. You just trade smaller positions and, you know, directionally be able to take advantage of the currency market and some of these fluctuations in a tax-deferred way. So what a huge benefit that you guys offer.
Right.
If I can forward a question really fast, Jeffrey says, I'm 71 years old. Can I still set up an individual KIRA?
So you can set up an NDK if you are self-employed. So that is not going to have that age restriction. The government also increased that age restriction to, instead of 70.5 to 72. So you're still able to, but you'd have to show proof of income in any type of retirement account that you can still contribute to. You have to show proof of income. So if you have wages on your, when you're filing your taxes, you can still consider making a contribution. Yes.
Okay.
Can I just add one thing about IRAs and retirement, Rita? Just my own example, and I know that it's probably a mindset for many. I love the tax advantages, but a lot of younger traders, and I'm just self-talk here, I would say to myself, I don't have to worry about retirement because I'm going to make so much money being a trader. Who cares about having an IRA and having assets accumulate and continue to do so tax-free? So I am really stressing it as a mentor, just a kind of a life coach, that everyone should do this. It's like Mickey Mantle said, if I knew I was going to live this long, I would have taken better care of myself. So you also have to take care of yourself financially, so that when you get to be, you know, gray-haired guy like me, that you're set up to enjoy the years. And my retirement is going to be slumping over my keyboard. So anyway, I just wanted to give that advice. Please take it seriously. And even though we're short-term with what we do in trade, be long-term about your future and set up an IRA. And thank you so much for being a sponsor.
Thank you, Rita.
Yeah, of course. Thank you guys so much for having me.
Perfect.
Well,
have a wonderful Sunday.
Here we go.
Yeah.
Dale.
Here we go. Huh?
It's what they say, last but not least, right?
Definitely not least. So everybody, Jack is in the house. Hiya, Jack.
Hey.
Hi, Jack.
Hey, Jack. You know, people
Hello.
have been saying for 3 days, when's Jack on? When's Jack on? And it's so great to have you, Jack. I haven't talked to you since your last book, that Complete Guide to the Futures Market. I know you're a prolific writer, but if you could just write more so we don't have to wait a couple years between our conversations, I'd appreciate it.
Well, I'm doing my best.
Yeah, and Stephen kind of ruined my surprise for people that didn't read our schedule about your book title. And when I saw it, I went, wow, you know what? This is going to fly off the shelf. So here it is, everybody.
I got to give Stephen, because Stephen was the source for a couple of traders in a book.
Right. And I know why now. The title of Jack's new book is Unknown Market Wizards, the best traders you never heard of. What a great idea, Jack. What a great idea. And what an excellent book. And, you know, I was opening the beginning and you have this quote by John Kenneth Galbraith where it said there's two classes of forecasters, those who don't know and those who don't know they don't know. So I was a second one for a long time, and I've evolved into I'm one that knows I don't know. And, you know, I'm really interested in getting your perspective on, you know, what was a light bulb? Because you've done Market Wizards books, guys that have been in hedge funds, guys that are well-known, little book of Market Wizards. What was it that motivated you to look for, you know, what I call hidden gems that nobody knows about?
Well, I guess the real seed of the idea came because my starting with Manuel Bellari, this Fundseeder.com, Fundseeder, which was looking for unknown traders. And part of that in the very beginning was, well, if we find some really, good unknown traders, ultimately I'll do a book of that. And that was the very, very first thought of doing a book like this. And then the other part of it is, it's kind of the last full Market Wizards book I did. I did the Notebook of Market Wizards, which is more like a short narrative of key points drawn from all the books. But the last traditional type of style, where it's interviews with the traders and summaries of that and narratives about the traders, that style book, the last one I did was Hedge Fund Market Wizards, which had people like Dalio and and other some famous hedge funds in there. So this was like the exact opposite, So it's like you go to, and the idea appealed to me. The thought was, there are people out there, and not when I say people out there, I don't mean just U.S., UK. I mean anywhere, globally, and that are really, really good, trading their own account, doing terrific, better than probably 99% of well-known hedge fund managers, and nobody knows they're there. And some of these traders in this book, I mean, it's just extraordinary. I mean, there's a couple of guys in there that have like returns of around 300% for a decade plus, and that's annually, so those are ridiculous type of numbers. And then there are people in the book which have return risk numbers. I know people used to using the Sharpe ratio. I don't use the Sharpe ratio, but because everybody kind of knows what a Sharpe ratio is, the people in this book have, Sharpe ratios that are, I don't know, 5, 6, 7, really, really super high. But the amazing thing is, because their returns are so asymmetric, they have like
a lower rating,
very large returns on the upside, but not that many on the downside. Then if you use the type of return risk that I prefer, such a gain to pain ratio or a Sortino ratio, the numbers are just off the map. I mean, I've never counted traditional hedge fund managers with return risk numbers like that. So there's some people in here that was as good as anybody I've interviewed.
In my own way, having interviewed over 1,000 traders over the years, Jack, what I've learned, that there's a big difference between someone who's a great marketer and very popular, and somebody who's great in the market. So, when I'm bringing people in from Twitter, I look for the people that don't have a lot of followers and see what their kind of charts they're putting up, and follow them and bring them in and lift them up and give them some visibility. So I was very charged up when I saw the title. And I'd like to start with, you divided the book into two categories, futures and stock traders. And I'm curious as to what are the similarities, I'm sure there are, and if there are any differences between the traders that trade different asset classes like that.
Yeah, that's a good question. And the answer, I think, is that they don't form groups, So, a couple of the futures guys are similar because they originally traded, and a couple still do, they got started in the same prop shop. So they knew each other, and there were influences there. So there's some similarities there, but not because they're futures traders, but because of that background. But the group of futures traders are diverse among themselves with that exception, and the group of stock traders are diverse and completely different. So, like if I go to the stock traders, you've got one guy who literally started with like $5,000.
$2,500.
$2,500, better yet,
And he ran it to 50 million.
50 million, and I'll tell you, he's doubled it this year. He's literally doubled it this year. So, he's extraordinary. And he's done that. He started, as you read the book, but he's with penny stocks, that was like, and even now he still has a focus on various micro cap, small cap stocks. And so that's one approach. And then you have one guy in the book who doesn't use fundamental analysis or
I was going to ask you, what does he use?
So I got, books about Al. I deliberately didn't answer that question because when I would say that, it was like a teaser. Say, here's a guy, and another guy started with like under $100,000. When I finished the book, I think he was at 20 million, but he's well above there now. He's multiplied it a lot. So the chapter title was neither, because he doesn't use fundamentals and he doesn't use that. And I did a couple of, I haven't done many, I'm just starting the interview process, but I did an interview with it, and then a question would come up. I say, well, read the book and find out. But we're close enough now.
Yeah.
So what he does is he uses social media. And he literally doesn't look at a chart, doesn't care fundamentally. He doesn't want to know fundamental. All he uses is social media. That's it,
So he'll go to Google search and things like that to see what people are talking about.
He actually created his own, he formed a company, created his own software to make the process efficient. So his main source is Twitter. He also uses some other social media, but he used to do it by manually, but he ultimately created a software, rather elaborate software program, and that's turned into a service for professional traders.
Does he use it for both a contrarian view or going with the flow view?
Good question. Good question. It's mostly going with the flow. What he's trying to do is identify things before that are going on now, but people don't realize. So, for example, something like LaCroix years ago, where there was this burgeoning transition from sodas and to sparkling water, unsweetened waters.
Yeah.
And LaCroix was in the forefront of that. And at some point, of course, that became obvious. But by seeing these tweets, by being able to measure it relative to other things, he could see these bulge in his mentions of LaCroix. I mean, just lots of examples in the chapter. He was able to pick up on that trend, and just on that alone, I mean, the stock, quintupled or whatever. He was able to pick it up before anybody was really onto the trend. So that's one.
Wow.
That's one type, and that's the main type of thing he looks for. The other type is more like the contrarian thing. So, did you ever see the documentary Blackfish?
Yes.
So for those listeners who don't know it, it's about SeaWorld and this orca who had killed three of the trainers, but it's more about the mistreatment of keeping these animals in captivity. And that documentary generated such immense hatred to SeaWorld. So in that case, what he could see is it wasn't like positive numbers that he was seeing, large amount of tweets. He was seeing an inordinate amount of negative tweets about SeaWorld. So that became a sort of contrarian. That became a source of a reason to be short SeaWorld.
Okay. I have to ask you about this, and I also want to let my team know that they can come in. I know everyone has questions besides attendees, but Blake and Stell and whoever is on the team that may want to interject, feel free to do so. But I have to ask you about the bellhop in Czechoslovakia who day traded stocks and made a fortune doing it. I can just imagine the guy day trading and also bringing bags up to the room and people giving him a tip and him looking at the tip and going, wow, my day trade, I made 100 times what this guy is giving me. And they have no idea. They think I'm just a lowly bellhop. So tell us about that guy.
So I get the chronology. So this is one of my favorites. And this is exactly the type of person I was looking for. So let me give you the context here. So a fund seeder is a platform traders can link their accounts or whatever. And so we have a ranking thing there. You can see, so every now and, every periodical I'll go on and look at the top, 20 or 50 traders or whatever. But I kept on seeing this account always showing up in the top 10. And the program will show an equity curve. And so if you look at the equity curve, it's like one of those equity curves. It's like a Bernie Madoff type of equity curve, except we know it's real because it's linked to the broker. We're not getting the results from the guy, we're getting it directly from the broker. So we wonder, who the hell is this guy? And he wasn't trading much money. So I finally get him a call one day, and it turns out that he's a fellow who just finished high school in Czechoslovakia, went into military service for a year, didn't have a job, didn't have an education. So he worked for a bellhop for 10 years. During that time, he tried to open a restaurant. The business, he couldn't, he was trying to do both at the same time, and he couldn't manage people, and the restaurant flopped. So he didn't have, whatever money he kind of scraped together, and he never had much money. But he then started trading, and his first foray didn't work out. He lost the money he had, which was like, well, most of it, like 15 or 20,000, not much. Then he did some 6 months intensively research, came up with a methodology, which is still the core of his current methodology. And then he started trading, and from that point on, he's been like profitable just almost every single quarter. Now, he's never built the account into much money because he had no money to start with. So what he's basically been doing now for almost 15 years is he makes money on a small trade, like it's been small, between 50, it was originally like a little less than 50, now it's closer to 100. But he just makes him money, and every year he draws out his profits for living. So he's living on his trading profits. And because he never had a large account, he's always just making enough money to, to buy his house, to live, and that's it. So his account stays at the same size. His performance is pretty much the same. Now, people may say, oh, well, he's not making that much money. He's probably trading these offbeat things. He's actually trading super high volume stocks, in mega cap in most cases. And the reason is because when he started, he wanted a methodology that if he was successful and he ever had the opportunity, that he could then start managing money and not have to change the methodology. So even though he's trading a small account, he's trading an account that has, enormous capacity. And the way he figured out how to do day trading to be profitable, and I don't recommend day trade. Some people pull it off, but his methodology was he figured out, in fact, he was so naive, this is a good story, he was so naive, when he started doing his research, he noticed, boy, there are like 4 times a year where these stocks have these big moves, so didn't know why. And then he found out it was because it was the earnings reports 4 times a year, right? Yeah. And so then he started focusing on that. So by focusing on earnings reports, he could identify those days where there was lots of potential movement, where he could, because day trade will kill people because the transaction costs are such a large. But by focusing only, and he trades only the day after earnings reports in any stock he trades. And that's part of the methodology, yeah.
Wow, what a great story. And, let me ask you this, since you brought it up. I recommend that sometimes when people have windfalls in their trading, that they pull some equity out because, Jack, they're just digits in our account. And the same thing happens at Vegas when you convert your cash to chips. It doesn't feel as real. In fact, when I was at the Merc, I'd go to breakfast with guys that had, 5-figure swings in the morning. And instead of going down to Union Stations and avoiding the 30 below weather, we'd walk 6 blocks to Lou Mitchell's because he had a breakfast special, because then it's real money. And you needed a CPA to divide the check. Do you recommend that people take a portion of their profits so that they can at least, maybe put it into something more conservative, or how about enjoying it and spending it?
Yeah, I do. And I tell you, some of the traders in the book, even though they're making these phenomenal, I mentioned these traders making 700% a year, they still will pull out money. They still pull out, typically, true of all of them, but one in particular I can think of, pulls out money and puts it into different real estate things or whatever. So he's kind of getting a cushion of wealth, drawing money out, having other sources. And I think that's a good idea, because there are too many people who will make a lot of money and then end up blowing it all because it's still in the account and they get lax because they've done well. If you've pulled out money along the way, then you've kind of secured that, and it's a good idea, I think, overall.
Okay, you know, I'm very interested in the story about the futures trader who lost 500K twice. Maybe I could relate to him, maybe not the same levels, but I have a couple questions. After you lose 500K twice, how do you get funding to do it again?
Well, basically,
how did he?
You're thinking of, you know, it was his money.
Okay.
Well, what happened was he didn't go in with 500K. He built the account up. He started with a small amount, built it up to, in each case, between $500,000 and $1 million, and then blew it totally. This goes to your point about pulling money out. In fact, one of the times he bought a Porsche along the way, and the only thing he had left was that car. So if he hadn't done that, he would have lost the, you know, he wouldn't have had that. So at least he had the car left, you know. So it was his own money that he was blowing. So after he had made it, and he did that twice, but at least he learned a lesson, and he will never. He said, like, I think paraphrasing him, said, I said, I may be wrong, I may do this, because I will never, ever, ever, ever not have a stop on a trade. You know, I mean, just absolute 100%. There's not a single time I'll make an exception. He knows where he's going to get out when he gets in, and if he gets to that point, he's out 100% of the time. And having gone through the process of building, you know, a $50,000 account into an $1 million account twice and losing it all, that really instilled in him this absolute risk discipline.
Okay,
and
the other...
I have a question.
Go ahead, Sal. Yeah,
Thanks.
Go ahead.
First of all, I'm going to say it. You guys know it. Jack, when I started my first trading job a long time ago, my boss at the time gave me 2 books to read. First day, one was on bonds, futures, and derivatives. The other one was, you can't see it.
The original
New Market Wizards. I still have it, and I've read it like 10 times. I wanted to ask something. I worked for 10 years. I was a market maker in derivatives in the city of London. I met quite a few people on the floor. The prevailing characteristic that I found on most of them was that they were excellent in mathematics. I know there's a psychological aspect as well to trading, but from all your interviews and speaking to all these people, what would you say the most important or prevalent characteristic is in successful people?
Well, yeah, skill in mathematics is true of some of the traders in this book and in others. And some of them were brilliant in mathematics, like Thorpe, not in this book, but in the prior book. But as common denominators, if you had to say which trait is most shared by all these really successful traders I've reviewed, I would say risk management is probably number one. I mean, if you're looking for a common trait, and I can think of only one exception, and there's one interview that I would say at least one, maybe there's more, but one that I can think of out of all the chapters in the different Mark Wizards book. So that's probably the most common. I would say another fairly common one is discipline. These people tend to be very, very disciplined, in fact, it's no coincidence that it probably across the books there have been maybe 3 or 4 ex-Marines that are in there, you know, which is not a coincidence. You know, there's one in this book. One in this book is an ex-Marine and attributes the Marines, in fact, to his success in life, not just trading.
Blake Morrow, who is one of the partners here at Forex Analytics, is an ex-Marine.
Yeah,
and he is a very disciplined trader, and trades for Gelos. And I always thought that would translate. There he is, right there, Blake. Why don't you talk to Jay? Did that help you being a Marine, Blake? I always ask you that.
You know, I'd like to always think that I'm super disciplined, but you know, like anybody, you fall into traps. I mean, but it has helped me. I do believe. And you know what? I was just funny is I was just fumbling around trying to find my original Market Wizards book, and I actually lent it to a college student who I'd been mentoring. He's actually a family friend, and he's been trading for the last year. And I gave him my Market Wizards book a few months ago, and I totally forgot that I did. But Jack, huge fan, and thanks for being here with us.
I appreciate it.
Steve, you have a question for Jack? I can't hear you.
Can't hear you.
Okay.
Okay, sorry.
There you go.
I was muted from the headphones. I didn't realize that I pressed the button. So I said I had actually the same question that Stelios had, and I wasn't surprised to find out that the most common characteristics are actually mostly psychological traits, right? Because discipline and money management, in essence, they're both coming from the same psychological characteristics. Being able to follow a plan, being able to stick to the rules. And yeah, I'm not surprised that's what you found out.
Psychology is really more important than technique, and that's I think true. If anybody reads any of the Market Wizards books, then I think if you get it, you can't come away with anything other than that message. And particularly in this book, there are a couple of traders who, there's one in particular that I can think of. It is so essential to what he does. I mean,
was he one trained by Steve Goldstein? Who talks about?
He is one that Steve Gold, that works with Steve. Yeah.
Okay, yeah, because Steve talked about the closure and the process on the right side.
Yeah, so
psychology.
There's a lot of things in it. It's a matter of getting very, very focused. He prepares for trades. This particular trader will look for, like, say, it's going to be an announcement by the Fed or another central bank or some other thing that's coming up, and he will be first. I'll do all the research. He'll know exactly. He'll figure out every possibility that can come out. He'll know exactly what he's going to do, but then he gets himself sort of mentally in a state of preparation. He sort of almost mentally he'll do mental rehearsal for everything. So it almost becomes all automated that when it's happening in real life. But he's intensely focused on the psychological side. Also very important about, and a number of the traders talk about mindset, how critical it is, and that you have to be in the right mindset to be trading, and what to do to get into that mindset, and what to do if you're not in that mindset. This guy came up in a number of interviews. So there's a lot about psychology in this particular book and in all the other Market Wizards books as well. But I found it came up maybe more in this book than some of the other books even.
Another question I actually had is, if you've noticed, if there is a tendency for successful traders to focus more on shorter or longer term time frames.
Basically, it runs the gamut. I think in this book, if I've looked here, from this book, I would say a lot of traders in this book were focused very short term. And literally a couple of them are just trying to pinpoint an exact moment, critical moment in the market. And then they go in. The reason they've done so well, they're so prepared, they're so good at it, they go in really, really large. And they might be out in a half an hour. And if they're wrong, they'll be out in half a minute. So you do get, in this particular book, a lot of people focus on the short term. The Czechoslovakian bellhop, like in and out the same day, which is long term compared to the couple of guys who focus on the events. So there are quite a number of traders in this book with short term, but some of the other traders are longer term. We talked about the fellow who lost his, who lost nearly, his built account up to near $1 million, lost it twice. He'll be in the market as long until he gets his signal to be out, and that could be months, it could be a year. So he's longer term, or it could be 2 days, but he can stay with a trader very long term and ride it through some big gyrations, as long as he doesn't have his signal either to get stopped or to get out because he's reached his objective. That he'll stay with, and it could be very long term. So the social media fellow he also can trade. He can trade an idea for years, like Chipotle when they had the E. coli scare, because he monitored through his ways of monitoring social media, he was able to tell that this was still a problem quarter after quarter after quarter. And so while he may not have held the position the entire point, he was trading that idea for years. So it runs the gamut. You get people who literally are trading in a time frame of a minute to a half hour, and people who are trading, over time frame that could be years. So that's variable.
What you say in the book, Jack, is whether people are short-term or long-term traders. You say in the book that if you're looking to just spend 2 hours a week for 100% return, this is the wrong book.
Yeah.
And so no matter what these guys are doing, whether they're scalping, day trading, or position trading, I know it takes a lot of work. A lot of people think that, money's going to drop into their account. Everyone has a secret. The secret is there is no secret, right, Jack? It's hard work, it's perseverance, and living through adversity. Would you say that this theme runs through all the unknown market wizards that you have interviewed? Hard work.
They're all in their own way. They're all super hard workers. You'll see that in every chapter. An immense amount of work that they have done to put in, and
more than an 8-hour day I bet a lot of them.
One the fellow who talked about making 300% a year. He talks about how in the beginning he would be putting in 18-hour days, literally. The bellhop. He's hardworking by nature, like he's working as a bellhop. He's trying running a restaurant at the same time. But when you got the trading, so he only trades around earnings reports. But even that means that 4 months of the year he's super busy. I'm talking 4 months. I don't mean continuous, but over 4 months. 4 of the months he has most of his trades, and over 4 months he has reasonable amount of trades. 4 months he hardly has any trades, but he doesn't just take off and go on vacation. Those 4 months he's researching how to improve his methodology. So it's kind of innate in these. The ex-Marine built this elaborate software program to trade, so he could have a program that he could put in all types of scenarios, and when something happened, he'd be able to know exactly. It would automatically put in the orders. But that was an immense project, and that's besides the time he was putting in on trading. So they all tend to be really hard workers, and I think a lot of people go wrong because they think that trading is it's like an easy way to make a lot of money. Well,
when I was a rookie,
you could make a lot of money, but it's not an easy way to make a lot of money.
Yeah, when I was a rookie, a veteran pulled me aside and said, "Kid, this is a tough way to make an easy buck."
Yeah.
What do you think? Yeah?
I think that might even be a paraphrase of a quote in the book, I think.
Okay, so I wanted to ask you this. The title of the book, Unknown Market Wizards, and your first chapter is about someone that I know.
Yeah.
And I think a lot of people know. So you included Peter Brandt in this category. Right. What was the rationale for including someone who I think is well known in your book, Unknown Market Wizards?
And he's the one exception. And maybe the social media guy, because he built a company, some people may know him from that. But Peter was an exception and I acknowledge that in the first. I say, well, in the introduction, I talk about that. So Peter was actually was a catalyst for writing this book. I've known Peter for quite a number of years, and he's so right on his views on when he talks about trading and everything. And so many times he has such quotable things. And I hadn't put Peter in a book. The last Market Wizards book I did was back in the full one was in, I think, 2012. I may have known Peter at that point, but not well enough. And but once I knew him, I thought really it'd be a shame if his wisdom was kind of not immortalized in the book, And so Peter and I both live in Colorado. Well, now he's moved. So now he's not in Colorado anymore. But at the time, he was in Colorado. He was a couple of hours away from me. And I thought, well, I'm going to do the chapter. I'm going to do this book. I might as well do the book before he moves out of Colorado, so make it easier, because I know I'm going to include him. So ironically, though, by the time I got around to doing the book, he was already out of Colorado. But so I flew to see him in what was he?
Tucson.
Tucson, right. So thank you. You read the book well. So, but I wanted to capture what he had. So now, in a sense, he's known well in a certain audience because he has a very large Twitter following, which he's built over the years. When I was first going to had the thought to interview him, he didn't have this big following, and people didn't know him, and he never really managed. He managed money for Commodities Corp, but that's like years ago, and that's sort of a private prop type firm at the time. And he was never a manager that people knew, like a hedge fund manager. So he is unknown to still a large segment of the market. He's not known. He's only known to this narrow group of, not a narrow, but a group of traders who follow him on Twitter. That's why he's known. But the reason I made an exception is because I thought it was very important to capture him. I still felt he was relatively unknown to most people. He didn't manage money. Maybe a more unifying theme for the book is not just unknown, which is true for almost everybody, but they're solo traders. So we're not talking, there's no people managing other people's money. All of these traders are just managing their own account and doing extremely well. So, but that's a good question.
I love his work. He's a classical technician, cut his teeth on Edwards and McGee and the authors before that. And you know how what I really love, because I've heard this before, when he was a floor trader at the CBOT, Peter said you knew your account was in trouble when you started trading notes.
It's in the book, yeah.
Yeah, I mean, what a great quote, because they're less beta.
You have to be a bit old-time commodity trader to appreciate that.
Well, I'm old-time. So, Jack, is there anyone else that really you'd want to wrap it up with that's in the book that really is kind of a standout that you could talk about before we, wrap up this interview?
I think we've referenced a lot of traders in the book.
How about the tennis player?
Oh yeah, he's phenomenal. So basically, he grew up in kind of lower middle class London, and he started in his early teens or just before, so late for a tennis player. I think he started playing tennis about 12 years old or so, which is late for somebody who's going to turn semi-pro. And he was very, very good. He was pursuing that kind of intensively, and he thought he wanted to become a pro tennis player. But a couple of things happened to him. One was that he was being trained by professional players, and he's like one person who was now sort of no longer young enough to be playing, was coaching, and he kind of thought to himself, and he had to go. Another coach had to go back to school to learn a new profession, and he thought to himself he didn't want to, even if it being a profession where he succeeded, first of all, you don't know you're going to succeed, but then you would have to maybe end up having to be a coach or end up having to go to a second career in your 30s and stuff. So that kind of made him question that whether you want to be a professional tennis player. And then one day, his coach had set up him to play another player, a very good player. And after he won the set and everything, he told him afterwards he didn't want to intimidate him, but that the guy he played was a top-ranked player and so forth. And the fact that he could compete at that level, though, and he didn't feel, wow, I could really do this, kind of was an inner sign that he didn't have the passion to continue. So he actually ended up giving up. Then he got injured playing soccer, but he gave up that. Now he went on. He's one of those traders with the multi-100% a year returns. He's one of his idols is Ray Dalio, and an interesting sideline there is Ray Dalio. Some people may remember put up for charity. You could bid to have lunch with Ray Dalio. So he decided he was going to bid, and he was like the leading bid. And there was about half an hour left in the auction, and he had to get home. He got on the London Tube, and he got out. He was hoping to get back before the thing closed. And by the time he got out of the tube and had the connection, his cell phone connection, he found that somebody else beat him on the bid. He was number 2, so he was like devastated. And then it turned out that he called them and Ray offered to have a second lunch if he would meet the winning bid, and he did that. So, and he couldn't remember anything about lunch other than his conversations. I asked him what he had. I think he ate a single thing, But
well,
he's a pretty incredible trader.
Yeah, I would bid to have lunch with Jack Schwager. You could do that for charity. I could just tell from the reaction we got from when you agreed to be with us for the summit that a lot of people would. I'd rather have lunch with you than Buffett.
I would outbid you, Dale.
You probably could. I mean, you Greeks, you have a lot of cash. But Jack, if anyone in the audience would like to ask Jack a final question, here's my prediction, Jack. This is going to be one of maybe your best-selling books. You know what I love about the book? It gives traders hope, okay, that they don't have to come from a money background or be set up with a membership at the CME, that they could be a bellhop and they could be a Marine. And if they really put their mind and energy towards it and live through some tough times, it could happen for them. So this book is going to give hope to all of us that, do battle with high frequency traders and algos. Is inspirational.
Yeah.
So thank you, Jack.
Yeah, I appreciate that. And
Mr. Schwager, one question. You've met so many traders over the decades. If you were forced to give all of your money to one man, who would that be?
Blake Morrow.
But all of it. Nothing on the side.
There are a number of traders in this book that I'd be very, comfortable giving my money to.
Not on this book, generally, from all the books you've written.
You're not going to get an answer.
Yeah, exactly.
Anyway, Steve's playing hardball with you, but Jack.
Jack, can I say something really quick? I've had the 2 original Market Wizards books of yours, and I'm excited actually to read the new book. And what I've realized over the years, over the 20 some odd years, because like Stelios, that was the first book that I read in 1996, was the one that was published in 89 or 90, I believe.
Yeah, that's right.
Yeah.
That's right.
And so that was the first book that was handed to me with a Mark Douglas book, the Disciplined Trader, I believe. And it's been a staple of mine through the years. Like when I struggle in the market just like anybody else, Marine, ex-Marine, infantry Marine, it doesn't really matter. I struggle just like every other trader. I sit back and probably every 2 or 3 years, I'll read a Market Wizards book, and from the great Jack Schwager. And I highly recommend that everybody picks up all of the books that you've had and you've written over the years, because they're timeless. What traders experience today, despite the changing market dynamics with algorithms and volatilities changing in different marketplaces, as traders we still deal with 30 years later the same psychological issues. And what it does make us all realize is that we all are human and we all deal with those same issues and struggles. And it's not just you at home as an individual trader, it's everybody out there. So thank you so much for bringing that to light to the whole trading community.
Thank you. Appreciate that.
Well, much success. These guys aren't going to be unknown Market Wizards anymore, Jack. You know that, right? Yeah. All right. So anyway, Jack, thank you so much for being with us today, and appreciate it. And anything you want to say about Fundseeder before we say? before we say goodbye?
It's a Funseater. It's a place where you can get a free analytics as long as you either link your account or upload your data, and has some neat stuff, neat statistics, neat charts. You can even run technical analysis on your equity curve. So if you're a trader that wants to do some analysis on your results, it's a good place to go.
Might get discovered and funded too, right?
What's that?
Might get discovered and funded.
So, yeah, we're working with. We're currently negotiating with some institutional investing groups. I'm not sure which one, but ultimately we hope that one of them will be the key, and it'll be a source.
Love you, Jack. Thanks for all you do for the trading community, buddy.
Thank you very much. Appreciate it.
Thank you, Jack.
Thank you so much, Jack.
Thank you. Okay, bye.
All right, gentlemen.
Awesome. What a way to end.
Perfect.
Man,
Perfect nightcap, huh?
I was so upset, Stelios. I was running around. I was fumbling through all my books. I'm looking through my library. I'm like, where's my Market Wizards books? And I forgot that I did give them to the young man who's over at ASU now. That those of the traders that know, they'll listen to the Face webinar. They knew that last summer I had a kid, or a young man, I should say, who was in high school that has been picked up the Forex trading bug. He's in our chat room from time to time when he's not in class. And I gave him I think I gave him like 7 or 8 books, and I gave him my Market Wizards books. And those are the ones he has not returned to me. I thought he returned all of them, but I was so upset. I'm like, where's my Market Wizards books? Anyway.
Yeah.
Well, I had a great time. I'm not saying that I'm not a little spent, but what a great time. Look, we just got a comment. How about that? That we topped the last one with what happened.
That was hard to do.
Indeed, it was.
Absolutely amazing.
Let's hope that in January we'll find a way. I don't know how we can do this to top this one.
Yeah.
Let's bring Bernanke.
We have a high bar. We have a very high bar now. But I want to thank the Forex Analytics team, and Joe's part of the team for putting this all together. Go ahead.
Look at Joe is I don't know if anybody else from our team is I know I can see a couple of them logged on if they wanted to come in and say hi. Joe, I'm glad you dressed for the occasion. That's awesome. How you doing, Joe? Volume.
No sound, Joe.
You're muted.
Oh, hi.
Hi, mate.
Hey, I am tired. I wanted to say that, Dale, you did a fantastic job during these last 3 days, getting up early, sitting here in between each of the presenters and, doing the transitions and introducing everybody. And that's a lot of work. So I wanted to say thank you for that.
You're very welcome,
Yes,
Joe.
Coach. Yeah, you were amazing. Everybody was.
And I'm going to tell you, just because we're in the same time zone, I couldn't get up quite as early as Dale did every day. So Dale,
I overslept today, Blake. My alarm went off at 3:30, and for some reason, I woke up at 4:30. So I had to wake up, and shave and everything in a half an hour, and it was just enough time to get the cobwebs out.
Well, you made it.
Yeah.
And
Anyway.
you were you rocked it. So, and thank you, the rest of the team. Thanks for
Steve's
being part of
hard
this.
work, Stel.
And thanks everybody who registered, who came here to virtually watch the presentation. We do this for you, and we really hope you enjoy it and learn, as we all learn every day.
Yeah, and make sure you're waiting for I know not everybody was able to listen to every interview out there and every speaker. Steve's going to upload those in about 3 or 4 minutes. I'm joking, Steve. I'm joking.
5 minutes. 5. Give me 5.
He'll have those uploaded. Him and the rest of the team actually behind the scenes are going to have those uploaded within the next couple of days.
The plan is Tuesday.
Oh, nice.
Plan is Tuesday. Plan for Wednesday. Hope for Tuesday. And you guys can watch them all, because there's so many good interviews. I actually have to go back and rewatch a few because there were so many good tidbits of information throughout the course of the last 3 days. And we hope that you all enjoyed this event. I have to also mention one last thing before we go. Remember, Traders Summit, it is going to evolve moving forward. So what you guys see here now, this conference, we will have these again. But you're going to have a central place in the next few weeks to go to have fresh, intraday, actionable ideas from not only the group of people that you have seen throughout the course of the last 3 days, but all of the contributors that you've seen Dale interview, us interview over the last several years, especially for those of you that listen to our daily free face webinars. You're going to have a place to get fresh investment ideas called Traders Summit in the next few weeks. So be on the lookout for that. It's really exciting. It's a collaboration that we're doing with Forest Park FX and other organizations, which, you know, I think for us, it's going to be a great place. I say for us as traders, it's going to be a great place to get ideas on the fly. You know, what's happening? Why did gold just move? Why did the S&P just drop 2%? And why did it rally back 3%? You know, those types of ideas and what's moving the market, you're going to be able to have that here in the next few weeks. So just be on the lookout for what's coming with Traders Summit. There's a lot of great things happening, and we're excited to bring it to you guys.
Well, everyone, enjoy the rest of your weekend. Remember, don't just count your pips, count your blessings, and we'll see you Monday on, we'll see you tomorrow on Face.
Yeah, tomorrow's Monday.
Can't wait.
I put on the chat once again, because somebody asked, the Face webinar registration link. It is a daily free webinar that almost every day includes an interview as well. So, I mean, you know, yeah, meet us there.
You know what? And hey, before we go, I do have to say one last thing. Thank you to all of our sponsors.
Yeah.
The actual summit itself, the last 3 days, couldn't happen without our sponsors. Yeah. They've been very generous. They've been awesome to collaborate with. Make sure you visit our sponsors, please, because they're the ones that make it all possible. So thank you so much to all of our wonderful sponsors there.
Absolutely.
All right.
Okay.
I also just added the link to the Forex Analytics sponsored, so people that might want to open another trading account, if they do it through that, to Pepperstone, they also get 2+2 months free of Forex Analytics.
Of Forex Analytics, guys. You can get Forex Analytics for free for a few months, actually. So, yeah.
Face is a place to become a trading ace. See you tomorrow.
Awesome.
All right.
All right.
Have a wonderful Sunday.
Sunday.
Bye, everybody.
We'll see you guys.
Bye-bye.
Thank you for all the support.
Adios.